Welcome back everyone, this side Mayank Kothari. Today we are going to start with a new chapter, that is foreign exchange exposure and risk management. This is chapter number 10 as per our syllabus, the sequence that we are going, and chapter number 9 as per the institute's syllabus. We have completed the interest rate risk management chapter before this, and the derivative was also a good chapter before that. There was one type of asset under the derivatives that we didn't discuss in the derivatives chapter because it was not covered in that. That was currency derivative. Currency derivatives will be discussed in this chapter, foreign exchange exposure and risk management. But don't worry about it, as the derivatives part of the currency is hardly 10 to 15% of the entire portion. But we are going to learn a lot of things apart from that. We will start from the basics of the Forex, and then we are going to shift toward to the difficult questions, and the last questions are going to be very important for you. That is one thing. Okay, this chapter is very important, sir, from the exam point of view. If you are thinking of leaving this chapter or skipping this chapter for your preparation, that means you are thinking to skip the entire subject. Please understand, instead of skipping it, you should be focusing on how you can make it your strength in your exam. So focus on the concepts more than solving the question in this chapter. I will tell you, there are hardly any formulas which will be applicable in this chapter. Very few, okay? But only few formulas are there, but most of the part in most of the questions are based on the concept, and sometimes it's very difficult to apply brain in that. See, formula related questions are very easy to solve because you can mug up those formulas and 80% of the work is done. But in this chapter, nothing related to that is going to work. All those strategies are not going to work, because even though this question might seem small to you, you will have to apply your smart brain in order to pick the correct rates or the correct values and then put it in the answer. I will tell you, solving the question won't be a difficult task, but picking up the correct values is going to be the difficult task. So focus on picking up the correct values. Understand, I'm repeating once again, focus on picking the correct values instead of solving the question. The length of the question won't be a matter to you, but the rates, the values will be given in numbers, and you will have to pick the correct one, because the moment you pick the incorrect one, your entire answer is wrong and you will not get the step marking, because the first step itself was wrong. So you have to focus on the concepts a lot. We are going to go a little slow while discussing the concept, and we are not going to solve much of the answer related part in the separate book, but in the compiler itself, because there will not be any need for so many calculations. The only thing that you will have to apply is the brain, that okay, out of the 3 figures, okay, this one is the correct one. That's the main thing in this entire chapter. In total, there are 112 questions, sir. I think after security valuation, this is the largest chapter in terms of number of question. But I will tell you one thing, security valuation can also be considered as on the easier side as compared to the Forex, because security valuation also consists of a lot of formulas, and 80% of the work is done when you apply the formulas. But in this chapter, you will have to be very careful while solving the questions. Okay, in terms of exam, like from the exam point of view, you can say that this chapter is around 20 marks of the question can be asked from this chapter. So 1/5 of the entire syllabus is covered by the Forex itself. So it's not good to even think about skipping it. Okay, there are two chapters related to the foreign currencies, which is foreign exchange exposure and risk management, and then international financial management. I will tell you, one big chapter and one small chapter supporting to that big chapter is there after the derivatives. So for the derivatives chapter, interest rate risk management was playing the part of the supportive role, and for forex, international financial management is the is giving the company, and for mergers, corporate valuation will give the company. But we'll start the corporate valuation first and later on the mergers and acquisition. So yeah, all these things are there. What else we can discuss before starting the practical question or the concepts? Okay, let's come to the concept sheet. Now understand that there are various types of questions, and obviously there are many repeated questions out of 112 questions. Let's say for example, the starting questions like 1 to 7 are uh, are independent questions, and then you can see that question number 9 to 12 are based 9 to 11 are based on cover rate. So what I can do, if all the questions are same, I can take one question and then I can skip the other ones and I can keep it for homework if they are the easier one. And like that, if we just move on to the next page, it's like interest rate parity theory. There are a number of questions repeated for this concept. Then purchasing power parity. Then you can see currency arbitrage with cross rate. So there are 4 questions. Obviously we are not going to discuss all the 4 questions. Hardly couple of questions will be sufficient enough. Most of the questions which are repeated are having just the different values, so it will be very easy for you to solve the repeated question when you have the time and you want to practice a lot. So currency arbitrage with interest rate differential, you can clearly see that. Investment borrowing or surplus or deficit foreign currency, there are many questions for that. Leading and lagging, many questions on that. Hedging with the forward contract, many questions on that. Hedging with forward or options contract, options, money market, forward. So this is the derivative related part. So the derivatives related part will start from somewhere from question number 63, or I think question number 57 itself. Most of the derivatives related part is covered under forward contract. So future, options and swaps, please, I'm repeating once again, futures, options and swaps carry a less number of question, but forward contracts will be a lot in number. Yeah, the end of the derivatives, currency derivatives part will be the question number 88, and then you will start with something related to delivery, cancellation and extension of the contracts. But yeah, the forward part will continue in that for sure. It will continue till this point, question number 107, and then nostro. So all the questions are based on nostro, vostro and loro account. So you can clearly see that although the number of questions are 112, but there are many repeated questions, many. So we are not going to take much of the time to complete the syllabus. Most of the focus will be on the concepts rather than solving the questions, and every difficult questions will be covered in this fast track batch, and the repeated types of question will be given mostly as an homework. That's it, sir. This is basically the introduction that I wanted to give you. I think we should start now with the concepts. So this is the forex related chapter, sir. Have a look. The very first thing that you need to understand is there are many currencies. Different countries have different currencies, and for that I will request you to open the chart. So if you have the charts, you can just open up the foreign exchange and risk management related chart, and I will show you one thing there. On the second page of the forex chart, like 10th number is for the forex, and 11th number, half of the 11th number is also for forex. So on the 11th chart, you can just come to the end of the forex part, and you can clearly see that I have picked up a few countries which will be used most of the time in your practical questions. So I thought you should know the code or the currencies of at least this much of the countries. So very first is the Indian currency. Obviously India is the country, the currency is Indian rupee, and the code is INR. You can clearly see that on the last column there is a column called as ISO code. It is called as ISO code. International Organization for Standardization. It is called as International Organization for Standardization. So these are the ISO code. Now understand, I hope I have explained this in the previous chapter as well, but I will just repeating it. The first two letter indicates the country, that is IN for India, you can see. Just a second. IN for India, US for United States, JP for Japan, GB for Great Britain means England, CA for Canada, CH for Switzerland, AU means Australia, SG means Singapore, EU is Europe. So this is continent basically, not a country. And the last alphabet represents the currency of that country. Currency of that country. R means rupees, D means dollar, Y means yen, P means pound, D means again dollar, but in this case it will be Canadian dollar. USD means US dollar, CAD means Canadian dollar. This is franc, F for franc, Swiss franc. AUD is Australian dollar, SGD is Singapore dollar, R means euro. Okay, so EUR is something which explains the currency as well, and the continent as well. Okay, so this is the basic that you need to know. Also, most of the time the exchange rates will be quoted in terms of ISO code. So there is a method of quoting the currencies or exchange rate. And what do you mean by the exchange rate? First of all, understand exchange rate. Exchange means you are exchanging one thing with another. So if I write down rupees per dollar, understand 80, that means this is represented in terms of symbol, and in the other countries you can say, or the international standard is not as per this. Please understand, this is what we use most of the time in India, but rupees per dollar, this system goes like this. We have to read it like this: rupees first, per dollar 80. That means 80 is the rupees and 1 is the dollar. So in this case 80 will be rupees and 1 will be dollar. So what is the exchange rate? Exchange rate is the rate at which one currency can be converted into another currency. So let's say for example this is rupees, okay, and this is dollar, okay, this is dollar. So I have to pay 80 of this item in order to get 1 of the dollar. It's very simple. Rupees per Parle G biscuit is 5. So you give 5 rupees and you will take 1 Parle G biscuit. Rupees for hide and seek is 30. So you pay 30 rupees and you will get 1 hide and seek. So you can clearly see that one item that you are receiving from the shopkeeper, whether it is hide and seek biscuit or Maggi or anything, a milk powder or anything. So that item is called as the product, right? And the rupees that you are paying for that product is called as the price of that product. In this case also, we are buying one currency and paying the price of it in another currency. The difficult part will be that both the product and the price both are in currencies. So sometime it will be very difficult for you to understand. So let's see, for example, rupees per, I will say, hide and seek is very easy to understand. If I ask you what is the product in this, you will be very comfortable in explaining or giving the answer that hide and seek is the product. But if I say rupees per dollar, then sometimes it will be very difficult for you to explain what is exactly the product and the price of it. But please understand, consider this and this as same. If you want to make the calculations and forex easy for you, the very first thing that you need to understand and be clear about is what is the product in the quotation, or what is the base currency in the quotation. This is the base. This is the base. So this is called as base currency. This is also called as product. Okay. This is one way of presenting the quotation, but it is not as per the international standards. So what is exactly the international standard of presenting the quotations? See, throughout the countries, it is presented in this form: USD, INR, 80. Now what exactly is this? And one more rate is there which is called as 80, let's say 82. Okay, so this is how most of the questions will be, but the local version of presenting it will go like this: rupees per dollar 80, 82. Since I don't support this, no international country, the other countries will also not support this, but the questions can be asked in this, and a lot of questions are there in our syllabus also with this quotation. So we will understand and learn about it, and then we'll forget it. So the mostly or widely used term is this: USD INR 80, 82. So there are 4 different terms in that which you need to understand first. The first is to how to read this. Should I read USD INR 8082? You can do that. But 80 is the INR for $1. 82 is the INR for $1. So mostly what you are doing is you are reading it in this manner, from right to left. From right to left. 80 rupees per dollar, 82 rupees per dollar. But what happens when it is given in terms of symbol? We read it like this. Locally in India, we do it like this: rupees per dollar 80, 82. So this is how you have to read it first. Second thing is, most of the time, let's first complete this one. Now, let me just put a mark. This is called as base currency. I will just take it on this side. This is called as base currency, or you can call it as product in the quotation, or you can call it as underlying asset. Okay, base, product, underlying asset. This is called as price of the base product or underlying asset. So what exactly you are buying and selling? This base product or underlying asset you want to buy or sell, and the price that you have to pay for that is called as price, or you can say quote currency, or you can say counter currency. So mostly we will call it as a price for the product that we are buying. Keep it in mind and read it like this: INR 80 INR for 1 packet of Maggi, for 1 hide and seek, for 1 Parle-G, or anything. But USD is a product in this question. Don't keep it as a currency that you use it in daily form in this part. Okay. So if you are in India, this is going to be your home currency, INR, and USD is your foreign currency. Okay. And what is this 80 and 82? I will just explain that. This is called as bid rate, and this one is called as ask rate. I hope I explained it once in the interest rate risk management chapter. Let me just explain you. Bid rate. This is called as banks buying rate, and this is called as banks selling rate. Now understand, what does the buying and selling rate means? Banks buying rate and selling rate for what? What exactly the bank is buying and selling at this price? They are buying and selling the underlying asset. That's what you need to understand carefully. So what is exactly this? This is the bank's buying rate for the asset. So 80 is the price that you are paying. That means 80 is the rupees for this asset. So you have to read it from right to left, right to left. 82 is the bank's selling rate for this asset. So most of the student makes this mistake. This is a very huge point. Very huge means only huge point where student makes mistake. What they do, I will tell you. They just read it like bank's buying rate. And if the question says that if you have to buy rupees, then what will happen? They will just pick the buying rate. Whereas this is not the buying rate for rupees. Do you understand that? Focus on once again what I said. This is not the buying rate for rupees. This is the buying rate for asset, and the asset is dollar in this case. So the bank is buying dollar at this rate and selling dollar at this rate. If the question asks you that you have to buy rupees, that means you have to convert that requirement into the base currency first of all. So the very first thing in every quotation that you should write down is what is the base currency. The second thing is what exactly you have been asked to do in the base currency. If the question is not asking in terms of the base currency, you convert that requirement into base currency. And then you pick the rate, you will never be wrong. Just a small habit that you have to put in all the questions that you are going to do, and you will never be wrong again. I have seen a lot of students making mistakes since last 10 years in this part itself. What they do is they just read it as bank's buying rate. They forget this arrow. They forget the what is exactly the buying rate is for. The buying rate is for the dollar, sir, not INR. If the question says I have to sell INR, that means this is not the rate. See, if you have to sell INR, bank will buy INR. Understand? Bank will buy INR, but both of them are not the rates for INR buying and selling. So the very first thing that you should do is convert the requirement always. Stop that question there and convert that into the base currency. So whenever the question says that you have to sell rupees, understand, I have to sell rupees. What I will do is bank will buy rupees and then I will end up picking up this rate because bank's buying rate is this. But I forgot one point that this is not the buying rate for rupees. This is the bank's buying rate for dollar, not rupees. So what you have to do at the very first instance is whatever is the question, hold it there, convert that question into the base currency's requirement, that exactly what we want to do in the base currency, no matter what the question is asking, what exactly we want to do in the base currency. So if the question says sell rupees, that means buy dollar. And if we want to buy dollar, bank will sell dollar. This is going to be the rate. Bank's selling rate for dollar. Am I right? So this is how you have to interpret. Most of the students are making this mistake and losing marks. Don't just put all your hard work in one silly mistake. Okay? So this is one basic thing that we have learned till now. Okay, the another thing is there is one thing called as home currency. Okay. So if you are Indian, your home currency is INR. If you are American, your home currency is USD. If you are Australian, your home currency is Australian dollar. So home currency is a currency of your country. And all other currencies will be treated as foreign currencies. So understand, Home currency can only be one, but foreign currencies can be many, many. So in this question, since I am Indian, this is my home currency, INR, and this is my foreign currency. If the question is in the form of, see, I will tell you, USD, AUD. Now, both of these currencies are foreign currencies to me. None is the home currency out of this, because home currency is Indian rupees. If I am Australian, then Australian dollar will become my home currency and this is foreign currency. If I'm American, this will become my home currency and this is going to be foreign currency. So you better understand how to know which currency is your home currency. Next, there is something called as direct quote and indirect quote. However, we are not going to use it a lot because this creates a mess and this creates a confusion while picking the answer. So I'm not going to put you in confusion, but still it is a part of the syllabus and sometimes we are going to use it. So direct quote is nothing but, if it is in terms of foreign currency, if the quotation is in ISO form, so it will be foreign currency by home currency and then these prices. So first currency will be foreign currency, the second currency will be home currency in this case. And if the quotation is indirect, we will call it as home currency by foreign currency and the rates will be given like this. So if this is the format, then it will be called as a direct quote, and this is the format, it will be called as an indirect quote. But I will tell you one more thing. What will happen? If the quotations are given to you in symbol, like rupees per dollar, okay? Let me just write down first and give you an example as well. If it's in symbol, like rupees per dollar, what are you going to do? Home currency is nothing but direct quote is nothing but home currency divided by foreign currency, and foreign currency divided by home currency. So exactly opposite of that. So the very first thing before saying that if the quotation is direct or indirect, you will have to look at the presentation. If it is in ISO format, foreign currency, home currency will be direct quote. If it is in symbol format, home currency per foreign currency will be a direct quote. And the exact opposite of that will be an indirect quote. Again, second thing, let's say for example, USD INR is 50 rupees. If you want to buy $100, how much you will have to pay? $100 into 50 rupees. Am I right? 5,000. You can understand one thing, that we normally multiply the opposite currencies. One more example. Let's say rupees per mobile phone is 50,000 and I want to buy 10 mobile phones. What will be the total value? 10 mobile phone into rupees 50,000. So that's 5 lakh rupees. Can you see that what we are doing? The opposite values for the numbers, the opposite factors are normally multiplied. Dollar is multiplied with the rupees. But let me give you one more pattern. Let's say now the rate is given to you as INR USD 0.02. What is this? In this case, 0.02 is the price or in case of dollar. So 0.02 is the dollar for 1 INR. In this quotation, this is called as indirect quote because this is in the form of home currency and then foreign currency in ISO code. So 0.02 dollar per INR, 0.02 dollar per INR. Now tell me one thing. I will take the same equation. or same requirement, buy $100. Are you seriously going to multiply at this point? Since 0.02 is also dollar, 100 is also dollar, you need to remember that you have to divide it to get to the values, which will be 5,000. So final answer won't change, sir. Final answer of 5,000 rupees won't change. It's just the pattern or the approach that you have to remember. If the currencies are opposite, you are going to multiply, and if the currencies to the values that you are using, so 100 is the first figure and 0.02 is the only figure, these two are the only figure, and both of them are in dollars. Since both of them are in dollars, you are going to divide it. You try multiplying it, you will not get anything. You will not get rupees. Dollar when multiplied with the dollar will not give you rupees. Try to understand. Okay. When mobile phone will be multiplied with the mobile phone, it will not give you rupees. So for rupees, rupees should be multiplied with the mobile phone so that it will give rupees. Now, let's say for example, the mobile phones, understand what I'm doing, and this is going to be of real help to you later on. Mobile phone per rupee is 0.002. So obviously this is not practically possible to buy 0.002 mobile phones in 1 rupee, but just take it like this. Now if you want to buy 10 mobile phones, what are you going to do? 10 multiplied by 0.00002 is not the solution, sir. At that time you will have to understand that 0.00002 0.00002 is the mobile phone. So the factor of this number is mobile phone. This is also mobile phone. If both are same, we will divide it. The answer will be 5 lakh. The answer, final answer will not change, sir. 10 divided by 0.002. Yeah, 5 lakh. So you understand one thing. The entire purpose of explaining this is when the two currencies are same, when the values to the currency or currencies to the values are same, you are going to divide it. If it is opposite, you are going to multiply it. Most of the time people makes this mistake. They just multiply it when we had to divide. So one thumb rule that I can come up with is opposite currencies to values, then multiply, and same currencies to values, then what are we going to do? Divide. Understood? At that time we will divide. Okay, sir. So you have learned a lot, and one more thing you need to understand with this. How come the answer was same and the equation quotations were opposite? This was a direct quote for me. See, I am right now in India, and for me this is foreign currency, this is home currency, and this FCHC 50, FCHC 50. So this is a direct quote, and this is an indirect quote to me because home currency is written first. How come the answer is answered from both the quotations are same? Because this is the indirect quote of this. I will tell you one thing you need to understand. Direct quote is inversely related to indirect quote. So when you say 50 or when you say 1 by 50, 1 by 0.02, sorry, it's one and the same thing. The answer by 1 by 0.02 it will be 50 itself. So when you inverse the direct quote, you will get the indirect quote. When you reverse the direct quote, it will give you indirect quote. Do you get that? So any values can be converted from direct to indirect, indirect to direct, direct to indirect, indirect to direct. Just do the reverse of that and you will have your values. Okay, sir. So one more concept that we learned is direct quote is indirectly related to or inversely related to indirect quote. Till now, whatever we have learned is this. Normally, or maximum time, the international standard of presentation is USD INR 8082. In this first currency is the base currency, product or underlying asset. Second currency is the price, quote currency or counter currency. The first number is bid rate, which is the bank's buying rate. The second number is ask rate, which is the bank's selling rate. In all the 112 questions, there is only one question where 82 was given first and 80 was given after that. And a lot of students got confused as to why this is given. So at that time when 8280 is given, 82 will become the ask rate. So the rule to consider the bid rate or ask rate is not the first or second. It is the lowest price will be the bid rate in any quotation. Lowest price will be the bid rate. So 8280, 80 will be the bid rate, sir. Understand one thing. This is the bank's buying rate and bank's selling rate. Bank is doing a business in this and they are not going to make a loss. So always the bank's buying rate will be lower than the bank's selling rate. So if you have to find out what is the bid rate, it's very simple, sir. Bid rate is something which is bank's lower rate. I will just write it down. Another thing to remember. So let's take USD INR 8280. Now if you have to find out bid rate in this is going to be the bid rate and this is going to be the ask rate. However, you will not find so many questions on such type of mistakes. We can call it as a mistake itself. But in one of the question, institute made that. But the answer was correct. But student made the mistake at that time. Student carried that mistake. Institute didn't carry that. So higher rate will be the ask rate. Ask rate is the higher rate. And lower rate will be the bid rate. So the thing to remember is bank will always buy cheap, sell high. This is something that you need to remember always. They are not going to make a loss. They are always going to make a profit by buying at a lower price and selling at a higher price. Okay, so few things are already covered. One more I think I should explain is this. This will be very helpful to you. Let's say for example you have made a sale of $1 lakh today, but this is not the date when you are going to receive the money. You just made a sale today to some like foreign party in America, and you are going to receive this cash flow after 3 months. $1 lakh. What will happen? See, today the rate is rupees per dollar 80, but you are scared. You are scared that by the time you will receive the dollars and you will convert that with the bank, the rates will go down to 70. So in this case, you will get 70 lakh rupees. And in this case, you will get 80 lakh rupees. The problem with this 80 lakh rupees is you are not receiving $1 lakh today. So this is just a notional amount that you could have received if the other party would have paid this much, but he is paying after 3 months and you are scared that you will lose around 10 lakh rupees because the rates on that date, the exchange rate after 3 months will fall. Now, there is one solution to that. Don't sell it. If when the seller, when the buyer is going to pay you $1 lakh, you can keep that in your pocket or in your, we can say suitcase or whatever it is. Don't sell it to the bank and sell it only when the exchange rate goes up. Is this possible? No, sir. According to the RBI's guideline, you cannot keep beyond a certain, which is very small, beyond a certain amount, you cannot keep the foreign currencies with you. So the moment you receive it, you will have to exchange it with the rupees. You cannot keep the foreign currencies with you. So understand that. If you have to keep the dollar with you, you have to open a bank account in America. So in America, you can keep as many dollars as you want, but in India, you cannot keep that dollars. You cannot store foreign currencies beyond a certain limit and manipulate the market. You cannot say that I will just sell it whenever the market rate will go up. No, that is not going to happen. So the loss is confirmed. Exactly. And you are scared of this loss because right now you cannot hold on to this dollar. So there is one option today. What you can do is you can just enter into a derivative market called as forward contract. You remember? And you can fix the price of those dollars. You can fix the price of the dollar, let's say for example 76. So obviously it is lesser than 80 rupees, but it is better than 70 rupees. Understand? So once you fix this, you enter into a contract of forward sell because you want to sell the dollar. I told you in derivatives how to find out what exactly the contract has to be. Whatever we want to do with the base currency or the asset on the expiry is what we have to do in the forward contract. So we want to sell the dollar, that is the base currency. That means we will sell the forward contract. So you have promised today to sell the dollars that you are going to receive after 3 months at this 76. That means you will be selling it at 76 rupees for sure. Now, no matter what the rates are, even if it goes down or goes up, it will not affect your calculation. So it will be 76 lakhs that you are going to receive. And that's for sure. So it's better than 70 lakhs. Obviously not better than 80 lakhs, but it is better than 70 lakhs. So you can reduce your risk, eliminate your risk of changes in the exchange rate by entering into a forward contract. So understand, this 80 rupees is called as the spot rate and this 76 rupees is called as the forward rate. So there are two more concepts that you have learned today. What is spot rate? The rate of exchanging the foreign currencies, the rate of exchanging the other currency on spot. Forward rate is the rate of exchanging the other currency at some future date. Obviously the contract is to be made today, but the actual exchange will happen at some time in future, not today. So that's why it is called as forward rate. Do you understand that? I'm coming over to the chart and I will start with the basics that we have covered till now. So focus once again, we are practically revising what we have learned till now because this forms a very a huge part of your practice and the questions that you are going to solve. So exchange rate is the rate at which one currency is converted into another currency. The second thing is the base currency and counter currency. Base currency is also called as underlying asset. Counter currency is also called as price or quote currency. If the quotation is given like this, USD INR 68.90, you can say USD is the base currency and the price after that is the counter currency. So it has to be read from right to left. It has to be read. Please put a mark like this in your chart. It has to be read like this, 68.90 rupees per dollar. So what is per in this case? Dollar. Okay. So the above quote is read as INR 68.90 per dollar. Now, the second thing that we learned is the bid and the ask rate. Bid is the bank's buying rate for base currency and the selling rate for base currency. A lot of students will make this mistake. So please make sure you put a important box here. That buying rate is for the base currency, not the other one. Okay. So this is it. Bank always buy cheaper and sell higher. The second thing, another concept that we learn, the fourth one is the direct quote and indirect quote. Understand, direct quote, if the quote is given as home currency per unit of foreign currency, it is called as the direct quote. So understand, this is 68.90 is the home currency per unit of foreign currency. So per unit is foreign currency. Now in this case, it's a direct quote. If per unit is home currency, then it's an indirect quote. So one of the shortcut that you can write down is per unit of foreign currency is a direct quote and per unit of home currency is an indirect quote. Remember nothing but this. Per unit, that single item, per unit is foreign currency, then it's a direct quote. Per unit is home currency, then it's an indirect quote. Okay. And also direct quote is inversely related to indirect quote. Direct quote is inversely related to indirect quote. This is something I'm postponing as of now. I will just take it later on when the question will come, because this is a difficult part. Then we discussed about the spot rate and forward rate. Please understand, spot rate is a rate at which one currency can be converted into another currency at spot, means today. If you want to convert one currency with the other currency today, then this is the rate, and in some future date this is the rate. Now let's write down, let's say the spot rate for USD INR is 80.82 and the forward rate for USD INR is, let's say, 82.85. So if you look at the spot rates, 80 rupees is 80 is the rupees to buy the dollar. Who is going to buy the dollar? Bank. So bank will buy the dollar at 80 rupees and sell it at 82 rupees, making a profit of 2 rupees. Can I say that? That bank is making a profit of 2 rupees? Yes, sir. In the other case, bank is making a profit of 3 rupees. In forward contract, it is buying the dollar at 82 and selling it at 85. They are making a profit of 3 rupees. So this profit is called as spread. And it is nothing but difference between bid and ask. Okay, let's come to the other part. If you find out a difference between spot and forward, the bid of the spot and the bid of the forward, you will see it is 2 rupees and this is 3 rupees. Am I right? So 80 to 82 means 80, from 80 to 82 is 2 rupees and 82 to 85 is 3 rupees. So you can see that these 2 and 3 and these 2 and 3 are same, but the meaning and the use of these numbers are different. This is called as the swap points. And this is nothing but the difference between spot and forward. So it depends upon what exactly these points are. If these points are spread, then it is for the bid to ask conversion. And if these points are swap, it is from spot to forward conversion. So let's say, for example, you have only been given with the bid rate and then they are giving you a spread of 2 rupees. What does that mean? It means 82 will become the ask. And if they have given 85 rupees, this one, okay, as an ask rate, and then they have given 3 rupees is the spread, then 82 will be the bid. So you should know, if these rates are given and the spread is given, then how to calculate the ask rate. In bid, the spread will be added, and in ask, the spread will be deducted, so that you can arrive at the reach at the second part, that is bid. So 82 minus 2 is 80 and 80 plus 2 is 82. Can I make a formula out of this if I want to? Yes, sir. See, ask minus spread is equal to bid, and bid plus spread is equal to ask. Question may give you this much of the information only, and then you will have to first find out what is bid and ask, and then you will have to solve it. So this might happen. Also, in case of spot and forward, if I add the swap points to the spot rate, if I add the swap points to the spot rate, so 80 and 2, 82 and 3, can I calculate the forward rate? Yes, sir. I can calculate the forward rate. But let me tell you one thing. This is just one way of doing it. Spot rate plus swap points is equal to forward rate. Okay, spot rate plus swap point is equal to forward rate. But let me give you another example. 80, 82 is the spot rate, and let's say the swap points are 5 and 3. Sorry, 5 and 2. So how to calculate the forward rate? Sir, you just explained it to us that we have to add the swap points to the spot rate. So let's add it. It becomes 85 and it becomes 84. So this was the bid and this was the ask. Is it possible to have the ask rate which is lower than the bid rate? Never. Never is this going to happen. Why the bank, understand why in the forward market bank will increase its buying rate by 5 rupees and selling rate only by 2 rupees? Don't you think so? The bank is increasing the buying rate by 5 rupees and selling rate by 2 rupees. Exactly, this is wrong. The bank is never going to do that. It will never do that. It will never increase the buying rate more than the asking rate or the selling rate. So whenever the swap points are given to you in descending order, 5 and 2, they mean that they are expecting the market to go down, and that's why instead of adding, we should deduct it. So 80 minus 5 will become 75 and 82 minus 2 will become 80. You can clearly see that the ask rate is still higher. It will be higher. So it depends upon the swap points in the pattern of the swap points. It's not just add and less in this case. It depends upon the pattern. If the pattern is ascending, that means bid point is lower than the ask point, then we have to add it. If the bid point is higher, you should ask yourself first question, why the bank will increase its buying rate by more points than selling rate. So this is a descending pattern when the buying rate is higher. So in this case we deduct it. So let me just write it like this. So all depends upon the pattern. If the pattern is ascending, you are going to add it. If the pattern is descending, then spot rate minus swap points is going to be the forward rate. So the pattern itself will explain what the bank is expecting in the future, whether the rates are going to fall or increase. If they are not confident about the future, they will obviously decrease the rate, and in that case they will give the swap points in descending order. So the order matters a lot for the pattern. Okay, if it is in ascending, it will be addition. If it is in descending, it will be deduction. Coming back to this point, this is the spot rate and forward rate. I explained that to you. This is a spread and swap. Spread is the difference between ask and bid rate. Swap is the difference between forward and spot rate. Okay, again, that's it. One more name to the swap points are forward margin. So what is the margin to calculate forward rate? In the spot rate, if you add or less whatever is the pattern, you will get the forward margin. Okay. American quote is the quote in amounts of US dollar per unit of foreign currency. When USD is the price, understand, when US dollar is the price currency, it will be called as American quote. When foreign currency, when US dollar is the asset or base currency, it will be called as an European quote. However, we are not going to use it much in our example. But please understand, American quote is from the American angle where American dollar is the price, and when American dollar is the asset, it will be called as European quote. So basically for us, it's a direct and indirect quote type of pattern. Americans are calling it as American and European quote. They are not saying this is a direct quote for us. But practically speaking, if we look from our conceptual point of view, for them, this is going to be a direct quote, right? And this is going to be an indirect quote. But they are saying it as American quote and European quote. So it's all about people to people. Okay, so these are two more concepts that we are going to learn: cross rates and premium and discount. This is very important to understand, but before that we are going to take some questions. So let's brush up and let's actually give a push to the practical questions, and then we'll be back to discuss about the cross rates and premium and discount. But I hope you have, but till now you have understood the concept of exchange rate, base currency and counter currency, how to read it, bid and ask rate, and then direct quote and indirect quote, both of them are inversely related. What is spot rate and forward rate? The difference between spot and forward is called as swap, and bid and ask is called as spread. If the swap points are in descending order, you are going to deduct those and from the spot rate, and if they are in ascending order, then you are going to add them. All in all, with practice, it is going to be a strong point for you. So you are not going to remember all these things just with one lecture. So make sure that you are practicing it very good. One more request that I want to make is, before I start the question, please make sure that you are solving the question by your own, coming back to the lecture only when you think you are doing something wrong. But if you are going right, you will get to the question, the answer. But that's okay. If you are going failing in 112 question, that's totally okay, sir. For the first time, I can understand that you might fail, but please first try yourself on a blank paper. Read the question, don't read the answer. Read the question, try to solve it on a blank paper without taking any help of the chart, or you can take the help of the charts, because these are the concepts that you can brush up. Without looking at the answer of the question or the class, you should be able to solve it. So should be able to solve it doesn't mean you should be getting to the correct answer. It's practically okay to have a wrong answer or to stuck in between. But the only thing that I want, or I can just fold my hands and request you to please try and fail. That's much better than not trying. Okay, so let's take a break, and I will be back with the first question of the Forex. Welcome back, everyone. This side Mayank Kothari. Today we are going to start with the questions of the foreign exchange exposure and risk management chapter. Before starting this first question, I think we should discuss about the concept first, and for that purpose we need to come over to the theory book, that is volume number 3, and in that, if you will come directly to chapter number 10, page number 191. It's page number 191, Forex, question number 14. So this is the theory question which can be asked for 4 marks, and it was asked in May 2017 for 4 marks. Let's have a look on this. Explain the strategies for exposure management. So first of all, what kind of exposure we are talking about? See, exposure means risk. And what kind of risk do you think will be there to the exporter and importers? Exporter, who exports goods and services to the other country and receives in revenue in terms of foreign currencies. An importer is someone who receives services from the other countries or goods from the other countries and make the payment for them in the foreign currency. So what happens is, let me just explain that to you. So this is a timeline, and in case you are exporter, you are making a sale here, doing the transaction here, but the receipt will be the money, the revenue, the sales part will be received after, let's say, 6 months. Now what happens is that when you don't receive the money today, there arises the risk of fluctuating exchange rate. 1, 2, 3, 4, 5, 6. The risk of fluctuating exchange rate. Let's say, for example, $1 lakh is the total sale value. If you receive it today, the rate is 80, you will get 80 lakh rupees. but obviously you are not getting it today, and the customer will pay you after 6 months. So $1 lakh received here will be at risk. What kind of risk, sir? That the rupees per dollar on that date will be 70, falling exchange rate. The decline or the depreciation in this exchange rate will be the risk to the exporter. That when you will be selling those $1 lakh, it can only be converted into 70 lakh rupees, which is less by 10 lakh rupees here. In case of an import or purchase, let's say for example, you have to make a payment of $1 lakh and you will be making a payment after 6 months, not today. So after 6 months, what will happen? You will go to the bank. You will go to the bank to buy the dollar so that you can make the payment to the party sitting outside the country who has provided you the services or goods for this purpose. So when you will go to your bank to purchase $1 lakh, the risk is, let's say for example, rupees per dollar is 80 today. So if you buy $1 lakh today, it will cost you 80 lakh rupees. But the risk is that by the time you really want to buy the dollars, the rate might go up to 90 rupees, and then it will cost you 90 lakh rupees to purchase the same amount of dollars, which could have been purchased at 80 lakh rupees 6 months back. So yes, sir, there is a risk in waiting to settle the foreign currency. If you have the receipt or you have the payment, if you are waiting for settling the foreign currency, then there is a risk of exchange rate not going in favor of you, and at that time we have to do some kind of hedging. This is called as hedging. In order to remove risk, that means we want to hedge. That means there is one mostly or widely used purpose for that is, or the instrument for that is, forward contract. So you can enter into a forward contract today itself to fix the prices, and this way you can hedge yourself from the fluctuating exchange rate. You can avoid the risk that the exchange rate will not be in your favor on the settlement day. So this is called as hedging. So do you understand the risk now in this transaction? That's what we are going to manage in this question. Explain the strategies for exposure management. That means the risk management. Strategies for exposure management. We are going to read it line by line, and I will explain you the meaning of those. So there are 4 different strategies. First of all, 4 different strategies for the exposure management, and you can create a matrix out of these strategies like this. The very first strategy is strategy number 1, low risk, low reward. Low risk, low reward. What happens is that whenever you do some import or export, there arises the foreign currency risk that after 6 months you will be settling those foreign currencies at some rate which is not in your favor. So that risk is avoided by entering into a forward contract. Let's say for example that you have a policy in the company that whatever the transactions are done in foreign currencies today, you will immediately enter into a forward contract and hedge all of them, hedge all the transactions. Now what will be a good side for that is you are avoiding the risk of fluctuating interest rate, exchange rate. But you are also eliminating the possibility of exchange rate going in your favor. Let's say for example, you have completely instructed your staff that all the foreign currency transactions should be hedged immediately on the same day. What will happen? This is a good policy when you expect the exchange rate to go down in case of sale and go up in case of import or purchase. But what if you are expecting the market to go up? Sometimes the market can go up. And in that case also, if you are hedging the sales, that means you are removing the possibility of earning higher or receiving more rupees. So instead of 80, you could earn 85 lakh. You could receive 85 lakh, but now you are settling in 81 or 82 in hedging. In hedging, you might enter into a forward contract at 81 or 82 rupees or 78 rupees. So there can be a loss as well, and there can be a lesser profit instead of 85 lakh. So that's why this strategy is called as low risk. That means you do not take the risk. You are like, my policy is there. Whatever transactions I will do in the foreign currency, I will immediately enter into a forward contract for them, resulting into removing the risk altogether, and that's why no reward. So low risk, low reward. You hardly take any kind of a risk in this strategy, and you are not rewarded that much because you have not taken the risk. There will not be a reward for that. Let's read the first part. Acha. In this manner, there are four strategies are there. In this manner, four strategies are there that we are going to discuss. Okay. First of all. So now let's focus on the first part. Low risk, low reward. See, read it with me. This option involves automatic hedging. Underline the word. Please underline all the words that I am explaining. Automatic hedging of exposures in the forward market as soon as they arise, irrespective of the attractiveness or otherwise of the forward rate. I just told you that once the policy is framed that you have to hedge all the transactions, then you are not looking whether the transaction is going to result into a better exchange rate, and what you are doing is you are just hedging it automatically, and that's why you are losing the opportunity to earn a higher receipt also. The merits of this approach are that yields and cost of the transaction are known, and there is a little risk of cash flow destabilization. What is the good part about this method? The good part about this method is that you know how much you are going to receive after 6 months or pay after 6 months, because you have already fixed that amount in the beginning. But there are some disadvantages also. Again, this option doesn't require any kind of investment of management time or efforts. Understand? Write down. Doesn't require any investment of management time or effort. This is a very good part, that once I frame the policy, I don't have to look into it again and again. So I can save my time and money in that. The negative side is that automatic hedging at whatever rates are available is hardly likely to result into optimum cost. At least some management seems to prefer this strategy on the grounds that an active management of exposure is not really their business. So this is kind of passive management. This is a passive strategy. For me, if I implement this in my company, this is a passive strategy for me, and I will be like, okay, I don't want to earn from this exchange rate fluctuation now. I want to focus on my business. So what I can do is I can frame a policy and put it in the system in the organization. So whosoever is going to do the transaction, he will make sure that hedging is done at whatever the rates are available in the market. So there is absolutely no risk of exchange rate fluctuation. But obviously I will be losing on the attractive part also. If the exchange rate goes better, like today it's 80, tomorrow it can go to 90, and I will lose on that 10 lakh rupees of the extra income, because I might have entered into the forward contract immediately after entering into this transaction. In the floating rate era, currencies outside their home countries in terms of their exchange rate have assumed the characteristics of commodities, and all in all, what does this mean is that currencies are treated as commodities. Like I told you in the last lecture, that dollar is, I compared the dollar with the Parle-G biscuit and hide and seek and Maggie, because both of them are products, so commodities. And business whose cost depends significantly on the commodity prices can hardly afford not to take views on the price of the commodity. Hence, this does not seem to be an optimum strategy. All in all, I will tell you one thing. If your business is not into much of the foreign currency transaction, then it's okay to implement this strategy in the company to avoid the risk. All in all, what we are doing is managing the risk. And if the transactions are very less, you can implement the strategy that whatever the foreign currency transactions will be there in the company, I am going to hedge them for sure. Okay. But if the transaction value is is huge in your company, that means you are also losing an opportunity to optimize it, to reduce the cost, reduce the loss, or increase the profit by not actively participating in it, or by just implementing this strategy of avoiding the risk all the time. You should take some kind of risk so that you can make profit out of it. So this strategy is like for the people who do not want to actively involve themselves, who do not want to take any kind of risk, who are into automatic hedging, who are not into much of the transactions in foreign currencies. Okay, the second type of strategy is low risk but a reasonable reward. Now, how it is different from the first one? In the first one also the risk was low, in this also the risk is low, but in the first one the reward was also low, and in this one there is a reasonable reward. What might be the difference? It is the difference of participating to some extent. We were not participating in that, and we had a strict policy of hedging all the transactions automatically. So automatic hedging means there is no manual intervention of whether this particular transaction should be hedged or not. Now understand that if you are doing around 20 transactions of sale in a month, in the first part where low risk low reward is there, you are hedging all the 20 transactions automatically, whether it is sales or purchase, all the 20 transactions, so complete hedging is done. But in the second part where low risk and reasonable reward is being considered, just imagine that you are first checking all the transaction whether we should hedge or not, and passing on all the transactions which has to be hedged to some other department, and keeping some transactions out of 20, keeping some transactions open and not hedged. So when you keep it open, that means you are expecting a better rate to come for them in the future. So better rate doesn't mean increasing. For sale, the better rate is increase in the rates. For purchase, the better rate is decrease in the rates. So when you make a sale of $1 lakh, the better rate is 85 in the coming time. And when you make a purchase of $1 lakh, the better rate is 70 or 75 in the coming time. So better means which reduces your cost and increases your profit. Do you get that? So if you involve a little time of yourself or some management, or frame a policy like that, or hire someone who will look into all the transactions before it goes to hedging, and keep some transactions open, that means you are taking some kind of a risk. Now let's have a look on the statement. This strategy requires selective hedging. Underline this word, selective hedging of exposures whenever the forward rates are attractive. Whenever the forward rates are attractive. See, sometimes the forward rates are very attractive. It's 80 and someone is quoting you like 84 and you are expecting it is to go 85. In this case also it's better to hedge, because there is only 1 rupees of the difference, and it's not good to take the risk and keep the position open just for 1 rupees. When you can remove the risk and hedge yourself at 84, that means this forward rate is very attractive. Very attractive. Instead of a forward rate of 78, isn't the 84 rupees is very attractive? Yes. So at that time you are going to do the hedging. So you are selecting what transactions to be sent to for hedging. Now suppose this is the transaction and the rates quoted in the market is 78, and you are expecting that the rates will go to 85. Then the 78 is not an attractive rate. So in the second part, in the second strategy, you will reject hedging this transaction and you will keep the position open. Okay. But in the first policy, low risk, low reward, you will automatically hedge at whatever rates given. So that is what the difference is. What you are doing in the second part is you are not automatically hedging. You are doing it on a selective basis where the forward rates are attractive, but keeping exposure open whenever they are not. Successful pursuit of this strategy requires quantification of expectation about the future. You will have to find out what the market will be in the future. So yes, you will have to do some quantification. And rewards would depend upon the accuracy of the prediction. See, if I am expecting that the market will go up tomorrow, and because 78 is not a good rate, not an attractive rate, I am keeping the position open. Keeping the position open means not hedging. So if you are keeping the position open, that means The reward that you are expecting to receive will depend upon how good your prediction is. If the market rate goes according to your prediction, you will be rewarded, otherwise you will suffer losses. Okay. This option is similar to an investment strategy of a combination of bonds and equity. Combination of bonds and equity. Do you remember constant ratio plan? Okay. With the proportion of the two components depending on the attractiveness of the prices. In foreign exchange exposure terms, hedged positions are similar to bonds and unhedged positions are equities. So whatever you, in the constant ratio plan, if you will remember, we had invested 1 lakh rupees in equity and 1 lakh rupees in bonds in the portfolio management chapter. It was portfolio replicating model, portfolio rebalancing theory. So equity in this is like all the positions which you are which you have kept unhedged, and bond means safe side, means all the transactions which you have hedged. So basically unhedged and hedged, out of 20 transaction, let's say you are keeping 8 transaction unhedged and keeping 12 transaction hedged. So basically you have created, it would mean you have created a portfolio of equity of 8 crore and bond of 12 crore. Just an example. So unhedged and hedged position in this situation is compared with that question, equity and bond. Okay, so this is how you are still going to take low risk because you are going to do the hedging, but a reasonable reward will be there in this strategy instead of low reward. Now let's come to the other two parts. The other two parts consist of high risk. The first two strategies were of low risk, and the other two are of high risk. Now the third thing is high risk, low reward. When do you think you will take high risk and still you will be rewarded like nothing? In which type of situation you are going to take the high risk and still will be rewarded nothing? Just have a look. Perhaps this is going to be the worst strategy. Why? Obviously, if we are not supposed to receive any kind of reward, why are we taking risk? From this third strategy, the first one was much better. It was also not giving so much of the reward, but the risk was low. So perhaps this is the worst strategy, is to leave all the exposures unhedged. See, if you just decide to ignore all the foreign currency transactions in your company, what will happen? This will happen. You are taking so much of the risk and might be you will not rewarded for that. You are ignoring all the foreign currency transactions for the purpose of hedging. You are keeping it unhedged. And that's where this third strategy will come, as you will be said that you are taking high risk, and since you are not planning that risk properly, you will lose money. It's just like keeping 1000 rupees on the public road. This is very risky, obviously, and with low reward. Almost no reward in that. Okay, or we can also compare this strategy with putting your money in the equity share, just blindly picking up any stock and putting money in that. This is highly risky and you might not get reward when you repeat this procedure over and over again. The risk of destabilization of cash flows is very high. The merit is zero investment of managerial time or effort. See, the good part about this strategy is only one thing. You have decided to ignore all the foreign currency transaction. That means there is no time and investment involved for the management in this. They don't have to look for hedging thing. They don't have to look for whether the foreign currency transactions are resulting into profit or loss or whatever it is. So they are not giving any time and effort. So they can save the time and effort in this case, but still it is the worst. The fourth and the last one is the best strategy, I believe. It is highly risky and highly rewarding as well. This strategy involves trading actively. See, active means time is required. So whosoever is giving time and efforts, obviously he will be rewarded. In the currency market through continuous cancellation, understand, continuous cancellation and rebookings of the forward contracts. What will happen? You will enter into a forward contract whenever you think the market is going to go against us. See, I will just give you an example. Let's say, for example, you have made a sale of $1 lakh and today's rate is 80 rupees. Okay. and you wanted to hedge it. Okay, so you entered into 84 rupees of the transaction, forward transaction 84 rupees, because you were expecting that somewhere around 85 rupees per dollar will be the exchange rate after 6 months. But after 2 months, what happens is that you are even strong on the market, and you believe that after, on this point, you believe that after 4 months the market rate will be 90 rupees. Now what you will do is you will cancel this transaction of 84 and enter into a new forward transaction on this date, which will be somewhere around 88 rupees. Are you getting it? What is happening? First, you believed on at 0th point, you believed that the market will be 85 after 6 months, and you entered into a forward contract of 84 or 83. Okay. But after 2 months, you believe that still there are 4 months left to the maturity, right? After 2 months, what happens is economic situation has changed, and you believe that the market will go to 90 rupees per dollar after 4 months on expiry. So now what you are going to do is you are going to actively trade in the previous forward contract. You are going to cancel it at spot rate, and then you are going to again enter into a new forward contract, which might give you around 88 or something like rate. So this way you will again be benefited and be very close to the spot rate. So this involves actively trading in the forward contracts or hedging parts, and you are continuously cancelling and rebooking of the forward contract. That's the most important part, because this involves a lot of time and efforts. Few of the larger companies are adopting this strategy in India. In effect, this requires the trading function to become a profit center. This strategy, if it has to be adopted, should be done in full consciousness of the risk. So this is being adopted by a lot of companies in India. It is becoming a profit center also. So these are some words that you need to remember, whichever I have underlined, in order to find out which type of strategy is being followed in the question. So do you get that? See, this strategy is low risk, low reward. And just below that, we can say that low risk, reasonable reward. Low risk, reasonable reward. And here it is high risk. This is going to be the worst strategy, keeping all the position opens. High risk, low reward. In this, what happens is you take all the transactions into automatic hedging. So the risk is low, reward is low. In this case, you do the selective hedging. Low risk, low reasonable reward. Selective hedging. S for selective. And in this case, what happens is that you actively trade active, automatic, only 4 words that you need to remember: unhedged and selective. In this case, so these are the 4 things. Automatic automatic means these 4 words has to be remembered in order to find out which strategy is given in the situation or followed in the situation. If you are automatically hedging all the foreign currency transactions, that's low risk, low reward. If you are keeping all the transaction unhedged, see what is happening in this case is you are automatically hedging everything, you are automatically unhedging everything. So this is highly risky but low reward. If you are doing the hedging on selective basis, that's low risk but reasonable reward. And if you are actively trading in the market by continuous cancellation and rebooking of of the foreign currency transaction, then obviously you are taking the risk and you will also get the reward. So these are the 4 strategies. Now, coming back to the question, we can now easily solve it. It took us almost an hour, half an hour. See, so there are 4 strategies and you will have to find out which strategy has been followed in which example. First one, Kuljit is a wholesaler of imported items, imports toys from China to sell them in the domestic market to retailers. That means he is an importer. He might be paying some Chinese yen to the Chinese trader. Being a sole trader, he is always so much involved in the promotion of his trade in domestic market and negotiation with foreign supplier that he never pays attention to hedge his payable in foreign currency and leaves his position unhedged. Just underline this one. Which strategy is this? This is the worst strategy. Because he doesn't have any time, he does not pays attention to hedge his payable and leaves all his position unhedged. Don't you think it is coming under the third category, which is high risk, low reward? This is strategy number 3 that we discussed. Second, Moni is in the business of exporting and importing brasswares to USA and European countries. In order to capture the market, he invoices the customer in their home currency. What happens is that still Moni might be in India, but whenever he is making a sale to some parties, he is creating an invoice in dollars, and when he is importing some goods from Europe, he is taking the invoice in euro currency. So both the invoices of sale and purchase are in foreign currency. What does that mean? That means there arises the foreign currency risk to Moni. Lavi enters into a forward contract to sell the foreign exchange. Lavi or Moni, I don't know. So Lavi enters into a forward contract to sell the foreign exchange only if he expects some profit out of it. Otherwise, he leaves his position open. What kind of strategy is this? This is called a selective hedging. It is clearly written that the guy or the woman enters into a forward contract to sell the foreign exchange only if he expects some profit out of it, and otherwise he leaves the position open. This is called as selective hedging. This is strategy number 2. Low risk, reasonable reward. You are not keeping all the position open. This is not strategy. This is strategy number 3. Automatic hedging is strategy number 1. Low risk, low reward. That is not the case in this question. You are also not actively trading in this, right? Doing continuous rebooking and cancellation. So this is not strategy number 4 as well. So this is the strategy number 2, low risk, reasonable reward. Now strategy number 3. TSC Limited is in the business of software development. The company has both receivables and payables in foreign currency. The treasury manager of TSC Limited not only enters into forward contracts to hedge the exposure, but carries out cancellation and extension of forward contracts on regular basis to earn profit out of the same. As a result of the management has started looking treasury department as a profit center. Underline the word profit center. So all in all, from this strategy, you can easily say that this is an actively managed strategy. First of all, a different center has been created, active management is there, continuous cancellation and extension is also there. So this is high risk, high reward strategy. So people in this department is taking high risk. They are continuously entering into forward contracts and doing the cancellation and extension for a better rate. So this is strategy number 3 or 4. Third one to very worst. This was strategy number 3, this was 2, and this is 4th. Now, DNB Publishers Limited, in addition to publishing books, are also in the business of importing and exporting books. As a matter of policy, the moment company invoices the customers or receives invoice from the supplier immediately covers its position. In the forward and future market, hence never leave the exposure open even for a single day. What is happening? As a matter of the policy, they have created a policy. Whenever the company invoices the customers or receives an invoice from the party, either you will create a customer for the party, either you will create an invoice for the customer, or you will receive an invoice as a customer. The moment you receive or creates an invoice, you enter yourself into forward or futures market to hedge those transactions. So you are automatically hedging all the transactions. That's your policy, and you are not leaving the exposure even open for a single day. That means you are not taking any kind of a risk. This is strategy number 1, low risk, low reward. Have a look. High risk, low reward. This is the worst strategy when you are not paying attention to any of the foreign currency transaction and keeping all the position unhedged. This is the only thing that you need to remember in this. Low risk, reasonable reward is when you do the selective hedging. Wherever there is anticipated profit. So only then you are covering yourself. Earn profit, cancellation and extension, profit center, etc. are something which explains the strategy's high risk, high reward. And automatically hedging. Company plays a very safe game, or automatic hedging is low risk, low reward. So these are the 4 strategies that you had to mention in the very first question. So if you will create it like this, you will see that strategy number 1 in this question is highly risky but with low reward because you were keeping all the position unhedged. Strategy number 2 comes in this category, which is highly risky but low reward. Why it was highly risky? Low risk but high reward. It was highly rewarding but giving a low risk, or we can say reasonable, not highly, but you can say reasonable reward. So this was when the selective hedging was done, when you are not taking much of the risk but you are earning something. Then the third strategy comes under high risk, high reward. This was the strategy when you were actively trading in the market, in the third part. And the fourth part is low reward, low risk, when you are automatically hedging all the transactions and keeping no position for profit. So yes, this was all the question related to the exposure management. So let's have a look on question number 2. That's an easy question, and the formula and the concept is related to the bond valuation topic that you have learned. And in fact, in portfolio management also you have learned about this thing. The price of the bond just before a year of maturity is $5,000 and its redemption value is 5250. That means you can say that the capital appreciation is $250. Yes, sir. At the end of the said period, interest is $350 and the dollar is appreciating by 2% during this period. See, the question is asking you a simple thing, that is you have to calculate the rate of return. And rate of return when it comes to currency can be calculated in terms of dollar in this question and in terms of the other currency, or we can say home currency, which is not given in the question, and we will assume it as rupees. So rupees. So calculating the return in terms of a currency in which the figures are given is very easy. You can clearly see that the investment is 5,000 and the return is capital appreciation and interest, which is 250 and 350. That means $600. $600 is the return. Investment is $5,000 and the return is 12%. That's very easy if you want to calculate the return for US investor. Anyone who is investing in the dollar and wants the return in dollar itself. But when it comes to the other currency, you have to be careful in this equation. So you have to understand what does the dollar appreciation means. And you can take any figure to understand that. I will just show you. Let's take it here. Let's say, for example, this is question number 2. Okay. So you have invested $5,000 here. Let's say the rate of per dollar on that day was 50 rupees per dollar. That means we might have invested 2,50,000 rupees. You can just multiply 5,000 with 50. 5,000 with 50 and you will get 2,50,000. So the story is we had 2,50,000 rupees. We converted that into dollar and invested that in America. After a year, what happened is that we received 5,250, the redemption value, plus interest of 350. So in total, we received $5,600. And by that time, when we tried to convert the rupees into dollar, this dollar had appreciated by 2%. So can I say that 50 plus 2% will be the new rate? Yes. So the new rate per dollar is 51 according to the question. They said now that 2% is the appreciation during this phase in the dollar. That's 51. So if you convert that now, 5,600 into 51, it comes to 285,600. Okay. Now we can calculate the return in terms of rupees by taking rupees in the numerator and denominator. So the investment value was 2,50,000 and the redemption value is 285,600, including capital appreciation, including interest as well. So can we do the calculation? Yes, sir. It's very simple. 285,600 minus 2,50,000 divided by 2,50,000. 285,600 minus 2,50,000 divided by 2,50,000. That comes to 14.24%. So you can see that the return to non-US investor is 14.24%, and the return to the US investor was 12%. This is for US investor, this is for non-US investor. It's as easy as it is. But the problem is that how to solve this in exam, because in exam you cannot assume any rate. That in this particular example that I asked you, 50 was the assumed rate and then this figure was arrived. But I will tell you one thing, there is no need to take this exchange rate to arrive at 14.24%. The entire story is about this 12% and this 2% return, this 12% and this 2% return, which you can easily calculate. Because this 12% is the dollar return. If the dollar is appreciating by 2%, if the dollar is appreciating by 2%, this 2% is also applicable on this 12%. So how to do that? It's very easy. The formula is 1 plus home currency return. I will just give it names. Home currency return is equal to 1 plus foreign currency return into 1 plus minus change in exchange rate. Understand the figures that I am putting here. 1 plus 0.12. 12% is the return in foreign currency. 12% is the return in foreign currency. Now understand, if the dollar is appreciating by 2%, do you think it has to do anything with the capital appreciation, interest or principal value? Will you say that this 2% is only applicable on $600 and not $5,000? No, sir. The appreciation is in currency. It has nothing to do with whether this item is principal, interest or capital appreciation. All the cash flows related to dollar will have to face this impact of 2%. So this 2% is applicable on the principal value as well and the return as well. Understand? So 1 plus, why I am keeping 1 plus 0.12 is 1, this 1 ensures that I am also impacting the principal value and the return value. The return in dollar is 0.12, the principal is 1 rupees. On every $1 I am earning $0.12 of the return. That's what we have calculated. So on the principal and the return, both I am going to put an impact of the exchange rate. And what is this plus minus? If that foreign currency is appreciating, I will use plus, otherwise I will use minus. This question might have been like this, that if the dollar is depreciating by 2%, then you would have written 1 minus 0.02 if the depreciation is a case. So 1 plus 0.02. Am I right? So this is going to give you an answer. 1 plus return in home currency is equal to 1.12 into 1.02. That's 1.1424, and return in home currency is equal to 0.1424. That is 14.24%. So see, this is the formula that you need to remember. And it's very easy to remember that if you understand the formula. This is the 2% appreciation. Since it is appreciation, we are adding it to the base value, and means base value was 50. Understand one more thing. This one return in this part is this one represents the base value of the exchange rate. In this case, it was 50. In this case it was 50. So we are keeping the 50 intact and we are then adding 2% on that. That's why the plus sign is there. If we want to reduce it, if we want to reduce the 50, then we will use minus. And this entire exchange is impacting the principal value of investment and the return of the investment as well in the foreign currency. And this is how we can arrive at the same answer. So there is no need to know the exchange rate on that date. Have a look. So you have understood this 12%. For US investor, the return shall be 12% and there will be no impact of appreciation in dollar. For US investor, he has nothing to do with the appreciation in dollar. The appreciation and depreciation in dollar will impact the non-US investor. Okay. This answer is totally wrong. Do not follow this in exam as well. What they have done is they have only impacted the 2% appreciation on return, not the principal value, which is baseless, senseless nonsense. We can say anything to that, because whenever the dollar will appreciate, it will not appreciate only on the interest, it appreciates mostly on the currency, and that currency includes the principal and interest as well. Alternatively, it can also be considered that it is impacting the principal as well, and this is the proper answer. You go with this 14.24%. okay. Let's move on to the third part. Third part is an interesting, and with this we'll start with the hedging of the foreign currencies exposure. Let's read this. In March 2009, the multinational industries make the following assessment of dollar rates per British pound to prevail as on 1st of September 2009. See, in March 2009, they estimated that, let's say it is 31st March. No, it's 1st March. So we'll take 6 months. This is 1st March 2009. So 6 months from now, what will be the dollar rates per pound? So it will be like dollar per pound, or you can write it in ISO code as GBP and USD. Understand that every time you want to write the code in ISO code, the price will be written here and the product or the base currency will be here. But in symbol, the price will be written first. Now, you can see dollar per pound. It is dollar per pound since it is in symbol. So after 6 months, per pound dollar rate can be 1.6, 1.7, 1.8, 1.9 and 2, and the probabilities are this. So the chances of this value are given to you. What is the expected spot rate for September 2009? It is easiest question. It is one of the easiest question you can say. You just have to multiply the probabilities with the rates given to you and you can calculate the expected spot rate, which comes to 1.81. Are we okay with this? Now understand that you are at 1st March and you are supposed to you can expect that on 1st of September the rates of dollar per pound will be 1.81. See, this is not exam related question, but the concept is important, and since we have started the Forex chapter, that's why I'm taking this question. So you are expecting that the rates on that date will be 1.81 dollar per pound. If as of March, means today, the 6 month forward rate is 1.80. Today, the forward rate of dollar per pound is 1.80. 1.80. So there are two things, the expected value and the forward rate. Should the firm sell forward its pound receivable? Try to understand what they are saying. The question is, should we enter into a sale transaction? What do you mean by sell transaction? If you enter into forward sell, that means you want to sell, understand, that means you want to sell the base currency at some future date, which is 6 months from now. So if you are exporter, you will receive the pounds after 6 months and you would want to sell them to the bank. And since you want to sell the pound at expiry, you would want to sell forward. So this is a question where you are an exporter under which you are expecting to receive some pound pound on the expiry or after 6 months, and that you would be anyhow selling it in the market. You would want to sell the pound at expiry. That's why we are selling the forward. So sell forward always means sell base currency. In this case, pound is the base currency. It's pound receivable. They have also written receivable. That means we are exporter, due in September 2009. So see, after receiving the pounds, let's say for example 1 lakh pounds we are supposed to receive after 6 months, we can convert them in the market at $1.81 per pound. But today we can fix the contract to receive $1.80 per pound. So what should we do? Shall we enter into this transaction? Mathematically speaking, no. Since after converting at 1.81 of the spot rate, we will receive $1,81,000 as against 1 lakh pounds. But if we enter into a forward contract, we will receive only $1,80,000 as against 1 lakh pound. And nobody wants to receive lesser of the currency, less amount of the currency. So it's better to not hedge your pound receivable in forward market mathematically. So that's what is written here. If the 6-month forward rate is 1.80, the expected profits of the firm can be maximized by retaining its pound receivable. What does that mean? By retaining its pound receivable means not hedging in forward market. Since we can keep the pound receivable and we can sell it in the spot market at the expected spot rate. But practically speaking, the difference is very less. You are expecting that you will receive $1,000 more, but the risk is very high because this is just an expected rate and this is a sure shot rate. If you will give me an opportunity, I will go with the forward contract. I will be okay to lose $1,000, but this is a sure shot rate, 1.80, and this is a risky rate. So you just tell me one thing. You are going to receive 100 rupees. That's too risky in the equity market. If you invest in the equity, you will receive 100 rupees after a year. And if you invest in FD, you will receive 98 rupees at the end of the year. Which option will you go with? Obviously, I will go with FD because that is safe and that is sure, 100% guaranteed. But the first one is not 100% guaranteed, the 100 rupees. And since the difference is less, I will go with the FD. So practically speaking, you should go with the forward contract. But mathematically speaking, since it is giving you less amount of dollars, you will go with the spot rate. Means you will not hedge yourself under the forward contract. So that was one of the easiest question. Okay. Now I think we are going to discuss about the cross rates. Yeah, the cross rates will be there in question number 4. So I think with the help of question number 4, we will learn with the cross rates also. I will tell you the concept. Suppose I will go with the symbols as in question number 4. The symbols are used. You can clearly see dollar, yen, pound, yen, all that. So if rupees per dollar is 80, okay, and dollar per yen or dollar per pound is 1.20, okay. Can we calculate a rate of rupees per pound? That's very easy, sir. Rupees per pound, that's very easy. We have learned a concept in our school days. A by C is equal to A by B into B by C. This is called as cross multiplication. That's why this is called as cross rates. So cross multiplication means we can easily, in this equation, we can easily cross the B and the remaining on the right hand side will be A by C, which matches with this. So if we have to calculate the value of A by C, we can keep A by B into B by C. So B should be in the denominator in one quote and the numerator in other quote. In our term, you can clearly see dollar is the currency. So dollar is the base currency in one quote and price currency in the other quote. Remember that. Do not remember the denominator and numerator. Denominator and numerator is good in mathematics. But in order to solve the questions of currencies, you just need to make sure that this B has opposite position in two different quotes. So dollar in this quote is a base currency and dollar in this quote is a price currency. Then you can simply cross multiply this. So we can calculate the rupees per pound as in this manner. Rupees per pound is equal to rupees per dollar multiplied by dollar per pound. So rupees per dollar is 80 multiplied by dollar per pound is 1.20. That's 96. So we have a rate of rupees per pound as well. This was the easiest of the cross rates and the first only. So this was your first example. Let me just take you to the second part. Let's say rupees per dollar is 80 and pound per dollar is 0.80. Now you are facing the problem. I just told you one thing in the previous part, that let me just write it. B should be in denominator in one quote and numerator in another, right? In the similar way, we can write down dollar should be base currency. Dollar means the currency which is common in both. Dollar is the only currency which is common in both, and it should be the base currency in one quote and price currency in another quote. So that is what you have to remember. Okay. Now I will just go with this. Now you will face a problem for the same equation. You can see the common currency. First of all, what is the common currency? It is dollar, and this should be in the base currency in one quote and price currency in other quote. So this is the base currency we can clearly see in both the quotes. Now, without satisfying that condition, we cannot move ahead. And that's why what we have to do is either of the rates has to be converted into indirect quote. Whatever the quote are, you have to reverse one of the quotes. Since the rate that we need is rupees per dollar, rupees per pound, that means rupees has to be kept in the as a price and pound should be the base currency. Rupees should be the price currency, pound should be the base currency. So you can see rupees is the price currency in this equation and dollar is the base currency in this equation. This is proper equation. Now this quote is totally wrong. We need pound in the base currency, pound is the price currency in this. We need dollar as the price currency in this, which is the base currency. So everything is wrong with this quote. So we have to change this quote. What to do with this? If the condition is not being satisfied, change it to from direct to indirect. Simple and sober. So what are we going to do? We need rupees per pound, and for that let's frame the equation. Rupees per dollar multiplied by dollar per pound. Since we know that the quotation given here is not matching with this dollar per pound, so we have to reverse this quotation. It is going to look like this: rupees per dollar multiplied by 1 divided by pound per dollar. Can I write it like this? Pound per dollar, 1 divided by. Whenever I am going to reverse this, it is going to look like dollar per pound. If you reverse this, it will become dollar per pound. So I am reversing this equation. Now I can put the values and solve the equation. Rupees per dollar is 80 into 1 divided by 0.80, and that will give you an answer. In this question, it's 100. So you might say that the answers are different. It was 96 earlier. So just to avoid the confusion, I will change the 0.80 rate to something which is more possible. .833 is the proper rate. So let me keep 0.8333. So if we do the same thing here, 0.8333, so 80 divided by 0.8333 will give you 96. Now you can clearly see the answers are matching. That is called as rupees per pound. Okay. Do you get that? Do you get the part? What is the change from the first to second? In this case, both the dollar were in base currency, and that was not satisfying the question, equation. We needed dollar per pound. Understand? You create the equation as per the requirement, not as per the given data. So you wanted rupees per pound, so you have to keep rupees as the price currency. So rupees per dollar into dollar per pound. Rupees per dollar into dollar per pound. Okay. Now let's take the third situation. Let's say rupees per dollar given to you is 8082. This is more appropriate. Till now we have only discussed about the one-way quote, where the same 80 rupees can be used for buying and selling. Because it's the only figure in the quotation, we will use it for buying as well as selling. But the more practical approach is to present it in terms of buying rate and selling rate differently. So let's say rupees per dollar is 8082 given, and dollar per pound is, let's say, 1.20 and 1.30. Okay. Now the question is how to calculate rupees per pound. So whenever you have been asked to calculate rupees per pound, you will have to first find out the bid rate and the ask rate. So one by one we are going to solve. So first of all, the requirement is this now. Let me just keep it here. So first of all, let's write down bid of rupees per pound. Am I right? So whenever I have to find out rupees per pound, I can just simply write down rupees per pound is equal to rupees per dollar and dollar per pound. So if we have to find out bid rate, the equation is simple. Take the bid of everything, rupees per dollar into bid of dollar per pound. See, the equation is exactly same as it was previously. Rupees is in the numerator, that means rupees is the price currency. Here in this equation also rupees is the price currency. Pound is the base currency. In this equation also pound is the base currency. You can clearly see. And the other currency, which is the common one, that is dollar, is the base currency in one quote and the price currency in the other quote. Okay, so all the conditions are satisfying. But if we need bid rate, we have to take the bid of everything. If we need ask rate, we have to take the ask of everything. So first of all, let's find out whether the quote given to us is as per the requirement or not. Here we require rupees per dollar and the equation is rupees per dollar. So take the bid of that, which is 80 rupees. So I will just take 80 here. And then the second is bid dollar per pound. So is this dollar per pound? First thing to compare is whether the equation is as per the requirement. The given data or quote is as per the requirement. So we need dollar per pound, and the dollar per pound itself is the given data. So pick the bid rate of that, which is 1.20. And your answer will be 96. Okay, and when we have to calculate ask, we are going to repeat the same procedure of picking the ask part of the rupees per dollar into ask of dollar per pound. Okay, so ask of rupees per dollar is 82 and ask of dollar per pound is 1.30. That's 106.60. Got it? Both the things are clear. Now, this was the easiest one. In this part, the third part, I just wanted to make it clear how to calculate the cross rates of bid and ask. So what we have learned till now, let's just complete it. In the first part, we learned that the common currency should be base currency in one quote and price currency in the other quote. Okay, and we learned about this cross currency item, that is what we have learned in the school days as well. A by C is equal to A by B into B by C. And then the second part, we learned about how to convert from direct to indirect so that we can match it with the equation. In the third part, we introduced the two-way quotes, that means bid and ask, and we learned how to calculate the cross rates of bid and ask. Now I am going to implement this direct and indirect part and bid and ask part in the same example. So I'm going to mix up second part and the third part together. So this is going to be the real test for you. If you easily understand the fourth part now, then there is no need to worry. So rupees per dollar given to you is 8082. Okay, and let's say pound per dollar is equal to 0.7692 and 0.8333, and you have to calculate bid of rupees per pound. How will you do that? Without looking at the given data, first, according to your requirement, frame an equation. We know that if we have to calculate bid, we have to take the bid of everything. So bid of rupees per dollar. Why rupees per dollar? Since rupees is the price currency here, we have to keep it as a price currency itself with the other quote. And bid of dollar per pound. This should be your requirement. So the dollar, which is the common currency, should be base currency in one part and the price currency in the other part. Now look at the equations. Whether the first thing to look at is whether the equations are in the form of rupees per dollar. Yes sir, it is in the form of rupees per dollar. You can easily pick bid rate of that. So bid rate of that is 80. Now whether the equation is in the form of dollar per pound. No sir, it is not in the form of dollar per pound. Then what should we do? Sir, just do one thing. Reverse this equation. Make it dollar per pound. Now let me see. If we do that, what will happen? If we reverse this equation, it will look like dollar per pound. And if I reverse 0.7692, 1 divided by 0.7692, it comes to 1.30, and 1 divided by 0.8333, it comes to 1.20. Do you think after reversing the equation and converting it from pound to dollar, from pound per dollar to dollar per pound, still the equation is right? Wrong. This is not right. Because how can the bid rate be higher? How can the bid rate be higher than the ask rate? 1.30. Any particular figure, if you reverse it, the opposite of that will become higher than the second figure. You take any figures. Let's say for example, we take 0.50 and 0.25. Now in this case, this is higher amount, right? This is higher amount. If you reverse it, it will become 1 by 0.50, that is 2, and 1 by 0.25, that is 4. Now this is higher amount. So what should happen? It's very simple, sir. Whatever might be the quote, whether it is direct or indirect, the bid rate will always be the one which is lower. So this is going to be the bid rate. What will be the bid rate in this case? This is going to be the bid rate, the 2 rupees. This is going to be the bid rate in this equation. So what should we do now? It's very simple, sir. The conversion is not the problem. The placement is the problem. Placing the equation in this format will be wrong. So let me just write it once again in this format. 0.50, 0.25, 0.50. If you reverse this, it will become 4, and if you reverse this, it will become 2. So bid is written first, ask is written later. Bid is the smaller amount, ask is the higher amount. This equation is proper, but this is not a proper equation. 4 should become the ask rate and 2 should become the bid rate, which is the lower amount. So 2 should be written on this side. So how are we going to write it? It's very simple. The bid of a particular quote will become ask of the bid of a particular quote will become, this is the bid, and it will become ask of the indirect quote, and the ask of a particular quote will become bid of the direct quote. So 2 and 4. So when you reverse the direct quote of bid, it becomes the indirect ask of the indirect quote. When you reverse the ask quote of the direct quote, ask rate of the direct quote, it becomes the bid rate of the indirect quote. So that is what you have to remember. Why? Because the smaller amount will always be the buying rate for the bank. Smaller amount will always be the buying rate for the bank. So whatever you are going to do here, you just have to make sure that whenever you reverse the two-way quote, it should be replaced in this manner. So the bid of that quote becomes the ask of this, and the ask of that quote becomes the bid of this after reversing. So conversion is not the problem, placement is the problem. What are we going to do? We are just going to write down simply 1.20 and 1.30. So how did we calculate 1.20 and 30? It's the inverse of this. First of all, it's the inverse of this and it's the inverse of this. So you can clearly see that the bid rate of this quote, has become the ask of the other quote, and the ask of this quote has become the bid rate of this quote. So simply speaking, can I write down one simple formula to remember forever? Bid of the direct quote becomes ask of the indirect quote, and ask of the direct quote becomes 1 by bid of the indirect quote. Simply. So you need to remember this forever. Bid of the direct quote becomes ask of the indirect quote, and ask of the direct quote becomes bid of the indirect quote. So this is going to be true. So let's see. If we use this, ask of the direct quote was 1.30 and 1 by bid of the indirect quote, it was 0.833. So 0.8333 and 1 by bid of the indirect quote is 1.20. So 1 divided by 1.20, which becomes 0.8333. So both the values will match. Do you get that? The only thing that you have to do along with the conversion is, when you convert it from pound per dollar to dollar per pound, you have to remember two things. First, reverse this figures, and the placement should be opposite. Bid should become ask should become bid after reversing. That's the only thing. So what are you going to write down here when you reverse that? Can I write it like this? See, bid of the direct quote becomes 1 by ask of the indirect quote. So bid of this quote will become 1 divided by ask of pound per dollar. That's it. And now we can clearly see that we have converted our requirement into what is given in the question. Pound per dollar, and now pick the ask of that, that is 0.8333. In order to find out bid of dollar per pound, we have to take ask of pound per dollar. Bid of dollar per pound, we have to take ask of pound per dollar. You got that? This is the most difficult part. If you have understood it, you are going to make it big. So let's write down 80 into 1 divided by 0.8333. That's 96. Okay, that's one answer. Let's write down for ask. Ask of rupees per pound is equal to ask of rupees per dollar multiplied by ask of dollar per pound. And you can clearly see that the dollar per pound is not given. It is pound per dollar which is given. Okay, so we have to convert that from direct to indirect, and rupees per dollar is directly given to us, so we can pick the ask of that. Rupees per dollar is given, you can see here, and the ask of that is 82 rupees. So 82 multiplied by 1 divided by ask will become bid of the reverse quote, which is pound per dollar. So remember, I have changed it from ask to bid and dollar per pound to pound per dollar. 82 into 1 divided by 0.7692, which will be 106.60. So these are the 4 different types that you should remember. The fourth one is the difficult one. And in this, almost 99% of the varieties of the cross rates are covered. The first one was very easy. Step by step we learned everything. Related to the cross rate. First we looked at this common currency. We thought that, okay, this common currency should be base in one currency, one quote, and the price currency in the other quote. Okay. Then what we did is from direct to indirect, we learned about it. Then what we did is how to calculate it for bid and ask. And then we mixed the second and the third part as well. We mixed it, and then we found that whenever we convert a particular quote from direct to indirect, which is a two-way quote, the bid becomes the ask of the indirect, and the ask becomes the bid of the indirect. So that is what you have to remember. So whenever you have to convert the bid rate, it will be 1 by ask of the other quote. Okay, sir. So this is the learning that you have to take. Now let's try solving question number 4. This is the given data to you. See, the 1 unit is the base currency. So in the first one, this is the base currency. US dollar 1 is equal to this much of the yen. I can write it in symbol like this. Yen per dollar is equal to 107.31, and dollar per pound is equal to 1.26. In this case, it's dollar per Australian dollar. US dollar per Australian dollar is 0.70. So I have lots of things written over here. Calculate the cross rates for pound in yen terms. That means yen per pound. See. Yen per pound. So you have to first find out what is the other currency given with yen and pound. There has to be some common currency between yen and pound. See. So the common currency between yen and pound is dollar. So first 2 rates are enough. Yen with the dollar and dollar with the pound. And the question is also asking us about yen per pound. Yen is the price currency. Pound is the base currency. So 107.31 into 1.26 will be enough. See. Can I take these figures on the other side so that I don't have to come again and again here? I will take this data and paste it on the other side. Okay, so you can clearly see we want yen per pound, and for that purpose yen has to be the base price currency, pound has to be the base currency, and the other currency should be base in one quote and the price in other quote, which is dollar. And I think the rates are directly given to us. This is yen per dollar, this is yen per dollar, this is dollar per pound, this is dollar per pound. You can simply multiply it to arrive at the figure 135.21 yen per pound. Let's have a look on the other part. Calculate the cross rate for Australian dollar in yen terms. That means now this is again asking us for yen per Australian dollar. So what is the common currency in yen and Australian dollar? You can clearly see that this is also easy. Yen and Australian dollar has a common currency of US dollar. And in order to frame the equation, it's very easy. Yen should become the price currency, Australian dollar should become the base currency, and the other currency should be price and base in both the other quote. And the rates are directly given to you, 107.31 and 0.70. So there is no need to convert it into from direct to indirect. So this is both of these type of questions are covered under the first example out of the 4 that we discussed. This is the first part itself, the easiest part. Now, calculate the cross rates for pound in Australian term. Pound in Australian term means Australian dollar per pound. For that purpose, you can clearly see that what is the common currency in Australian dollar and pound? It's the dollar. But the main problem is dollar is price currency in both. So let's frame an equation. Australian dollar has to be the price currency. The other currency will be US dollar. So I will write down US dollar multiplied by US dollar should become price currency in the other quote because it is already the base currency in the first one, and the third one is the pound. Now you can see first of all which currency, which particular requirement is matching with the given data. You can see that the for this requirement is matching with the given data. We need it dollar per pound, and the dollar per pound is already given to us. That means we can simply write it 1.26. But you can see that we need Australian dollar per US dollar, and the data is US dollar per Australian dollar. So you need to change your requirement. What are you going to do? Since this is a one-way quote, this is the easiest one. This will be covered under the second part, I think. In the second part itself, because it was one-way quote. See, this is the second part. It was one-way quote, and we changed the direct rate to the indirect rate. So 1 divided by, now how I'm going to write dollar per Australian dollar, US dollar per Australian dollar. So 1 divided by, what is US dollar per Australian dollar? That's 0.70. See, US dollar per Australian dollar 0.70. So 1 divided by 0.70 into 1.26. Now you have the answer. That's 1.8. What is 1.8? Australian dollar per pound. See? So this was covered under the second part. The third and the fourth part were the difficult one, and the easiest part has been asked in this. So you can just imagine that this question is pretty easy than what it could have been. If they would have asked something out of third and the fourth part, it would have been more difficult for you. But you will have to use this part in the coming question. So we'll be referring this again and again. Okay, done with this question. Let's move on to question number 5 now. India Imports Company purchased 1 lakh US dollar worth of machines from a firm in New York. So just use your imagination. Something from the America has been purchased, the machines. Okay, so we have brought the machines from America. We have to make the payments of 1 lakh dollar to the other party. Okay, the value of the rupee in terms of dollar has been decreasing. What does that mean? The value of rupee in terms of dollar has been decreasing. It means that if rupee per dollar is 50 today, okay, it will, and if it goes to 52, that means, understand, the value of rupee is decreasing. rupee is going down, dollar is going up. Don't believe on the values. If the values are going up, that doesn't mean every currency is going up. One is going up and the other one is going down. Earlier we used to pay 50 rupees only to buy $1. Now we have to pay 52 rupees to buy $1. Just imagine, someday you will have to pay 1 lakh rupees to buy $1. Then what do you think? Whose value has decreased? The rupee value has decreased because you have to pay more of it to buy the same thing you could have purchased at 50 rupees or 50 only years before. Let's compare the Zimbabwe's currency. You can only buy 2 to 4 oranges in thousands and lakhs of Zimbabwe's currency, whatever it is. So the value of Zimbabwe's currency has decreased, and that's why you cannot purchase enough of it. So if today the dollar is costing us 50 rupees and tomorrow the same single dollar is costing us 1 lakh rupees, let's say, I'm just exaggerating this number so that it's very easy for you to understand. So tomorrow if the dollar is costing you 1 lakh rupees, that means the value of dollar has increased and the value of rupee has decreased. That's what the question is saying. The value of rupee in terms of dollar has been decreasing. So basically it means if today it is 50 rupees, it will be 52 or 55, it will be more. So what will happen? Today you have purchased some items, right? And tomorrow you are going to make the payments. So if today you make the payments, it is going to cost you 50 lakhs itself, and tomorrow it is going to cost you 52 lakhs. Let's say what are the exact rates. The firm in New York offers 2/10 net 90 terms. Now you need to understand what exactly the meaning of this. This is a standard term used in normally every trade. So 2% discount if you make the payment in 10 days, or else pay 100% in 90 days. So you understand that if you make a payment in 10 days, you will get a 2% discount on the invoice value. Otherwise, you have to pay the 100% without any discount in 90 days. So 2%, 10 days and 90 days. Do you get that? How to explain or how to interpret this? Now, the spot rate for the dollar is 55 and the 90 days forward is 56. Now, if the spot rate is 55 in the spot market, you can buy the dollar at 55. What is the product here? The base currency. The product or the underlying asset is dollar. So dollar, consider the dollar as a product, like this stand, mobile phone, like this. And you are expecting this value, the rupee value, to decrease. The rupee value to decrease and the dollar value to increase has the same meaning. And it can go, let's say for example, to 60. So this means that we have to pay more of the rupees to buy the same dollar. Okay. And today itself you can buy the contract 90 days forward rate of rupees 56. So the forward rate is also available today of 56. If you are scared of paying more money by the time you really want to buy the dollars, you can take the forward contract itself. And what exactly you want to do with the base currency on the expiry? You want to buy the base currency on this, means the dollar. So what are you going to do with the forward contract? Same, buy forward. Okay. Okay. Compute the rupee cost of paying the account within 10 days. If you really want to pay it in 10 days, we will assume the same 55 rupees is applicable because no other rate for 10 days is given in the question. So we will assume the same rate 55 for all the 10 days. So what is the rupee cost of making this payment? If you make the payment within 10 days, you will have to buy $1 lakh from the Forex dealer. Now, whenever you go to buy the dollars, according to RBI guidelines, you will have to buy it from the registered Forex dealers only. Most of the dealers can be found in your city itself, and mostly the dealers are banks. You can go to the bank and buy the dollars. Apart from that, also other than bank, also you will find in every corner, mostly if you have gone to Goa, you will find it that lots of shops are offering this foreign currency deals. So you can buy it at 55 rupees per dollar. So whenever you will go to buy the dollar, 1 lakh rupees is going to cost you around, okay, if you pay it in 10 days, the 2% discount will be given to you. So 1 lakh less 2% becomes 98,000. This $98,000 you will buy it at 55, and this is going to be the rupee cost to you. Okay. The second part, compute the rupee cost of buying a forward contract to liquidate the account in 90 days. Please understand, there is no discount if you make the payment in 90 days. So you will have to pay entire 1 lakh rupees at the agreed rate of 56. 1 lakh rupees at the agreed rate of 56, which is going to cost you 56 lakh rupees. Now, the great thing that you need to understand here is, if you make the payment today, it is 53 lakh 90,000 that you will have to pay. And if you make the payment after 90 days, you will have to pay 56 lakhs. So the increase in the outflow is 2 lakh 10,000. It is 2 lakh 10,000, and it has two components. It has two components. Why you are paying 2 lakh 10,000 extra? There are two components to it. One is the time value. Because you are making an early payment, you are getting a discount of $2,000. If you remove that discount, then this amount will get reduced, the difference. Also, if you, first is the time value, second is the fluctuating exchange rate. Now, read the third part. The difference between part A and part B, which is 2 lakh 10,000 rupees that you are paying extra, is the result of the time value of money. That is the discount on prepayment that you are getting, and the protection from currency fluctuation. Because you are not waiting for 90 days and you are just entering into a forward contract. So if you practically look at the transaction, if you make the payment today, the rate is 55. If you make the payment after 90 days, the rate is 56. So protection from the currency value fluctuation is 1 rupee only. 1 rupee on every dollar. That's 1 lakh. That's 1 lakh rupees. Out of 2 lakh 10,000, you can divide the difference of 2 lakh 10,000 into time value and currency fluctuation. Time value is nothing but 2% discount, which is equal to $2,000. Now imagine there is no exchange rates available in the entire world, keeping everything constant. If you would have, what is the benefit of this $2,000? The benefit of making an early payment is $2,000 multiplied by the same rate, 55, 55 and 55. You will not expect it to change. So we are basically taking the change in the change in the exchange rate on that side. So whenever we are calculating the time value, the impact due to discount, we will keep all the other things same. That means we are not going to change the exchange rate. We will keep it same as 55, 55, 55 all the time. Whenever you want to make the payment, it is 55 only. Since you are making the payment early, you are getting a discount from the trader. That is $2,000. So the time value of it is $2,000 into 55, that comes to 1,10,000. Okay, let me explain my own calculation and then I will explain the one done by the institute. So what happens is that when you want to separate the difference, you will consider one thing will change only at a time and other things will remain same. So there is no such thing called as exchange rate. This has been assumed. So we have multiplied. The today's rate will be applicable in the forward market also, and tomorrow also. So 55 is going to be constant. And because we are making the payment today, we have to pay $2,000 less. So 1,10,000 rupees less amount we have to pay today because of that. Or we can say we are paying the same 2,000 into 55 rupees more because we are paying after 90 days. Now, what is the difference just because of currency fluctuation? That means there is no such thing. What are you going to assume in this case? There is no such thing called as discount. So there are two types of assumption that you are going to take at every part. In this case, you will assume no exchange rates are available in the market, or you will say that exchange rates will not fluctuate, no fluctuation. You will assume that there are no fluctuation. And in this case, you will assume there are no discounts. So if you make the payment today, you will have to make it $1 lakh because there are no discounts. And if you make the payment after 90 days, you will assume $1 lakh. So in both the cases, you will keep the net amount $1 lakh. And only thing that you are going to consider is the change in the exchange rate, which has gone from 55 to 56. So in this case, 56 minus 55 1 multiplied by $1 lakh will be 1 lakh rupees. So this is how you arrive at a change of 2,10,000 rupees. 1,10,000 because of the time value and 1 lakh because of the currency fluctuation. The institute's answer is different from what I have calculated, and I am not satisfied with the institute's answer. See, question has clearly asked you to bifurcate that difference between time value of money and protection from devaluation. So obviously, whenever you solve a question from one point of view, you keep the other things remaining constant. If you remember the mathematics and everything that you have learned in the past, other thing remaining constant, we only calculate the impact of this. So the impact of devaluation, protection from the devaluation, is only this much, 56 and 55. Why we are taking the discount into consideration? In the second part, what has happened, you have also considered the time value of money. Why the values are 98,000 here? Because of the time value. The other party has offered you $2,000 of the discount. The original bill was never 98,000. There are two different things. Okay. If you pay today, it's 98,000. If you pay tomorrow, it's $1 lakh, right? So considering that $2,000 means you are considering the time value. And if you do not consider the time value, the amount is never 98,000. It is $1 lakh, which is the original amount of the bill. So you cannot consider 98,000 here. This is right, but 1 lakh should be there. And in the other part, they are saying we are considering time value of money. That means time value means what? Because you are paying early, you are paying $2,000 less. That I agree. But why 56? 56 is specifically a rate in forward market. If you expect there is no exchange rate fluctuation, then the rate in the forward, spot and tomorrow also will be same. That is 55, which is the original spot rate. So you should have taken 55 in this case. You can put your own comments in the Telegram channel if you have a valid justification for this answer and not for that answer. Okay, according to me, this is correct answer. But for exam point of view, right now I will tell you, follow the one which institute has done. Follow this one only. Keep whatever I have solved, keep that in knowledge only for the purpose of practical, like after exams, if in case you want to enter into this field. But for the exam purpose, for the marks purpose, this is only what you have to do, because I don't want just to follow the correct approach, you will lose the marks, because institute is following it and institute gives the marks according to their own answers, even if it is wrong. This has happened many times. So go with the institute's answer only for the purpose of marks. I hope you have understood the question. Question number 6 now. Now let's have a look. The current spot exchange rate is $1.35 per pound. 1 pound can cost you 1.35. So it's better to present it in terms of timeline. You will understand it better. Question number 6. So today if you want to buy the pound, it will cost you somewhere around 1.35, okay, per pound. So what is the base currency in this question? Pound. And the 3-month forward rate is 1.30. So today you can enter into a forward contract also at 1.30. According to your analysis of exchange rate, you are quite confident that the spot exchange rate will be, after 3 months, it is going to be 1.32. So this is your expectation that after 3 months it will be 1.32. $1.32. Now you tell me what the question is asking you. Suppose you want to speculate. Speculate means you are not an exporter, nor you are an importer. Because when you are exporter and importer and then enter into a currency derivative contract, because this is a forward, that means you want to hedge. But in case of speculation, you are a normal person who just want to make some profit. You will take a buy or sell position today and you will close it after some time and you would want to make a profit. In the forward market, then what course of action would be required and what is the expected profit or loss from this speculation? You can assume that you would like to buy or sell 1 million pounds. Just imagine 1 million pounds. What course of action do you think you should take? You are pretty much confident. See, this rate is not at all applicable or useful to you. This is useful. See, both of this one and this one are the rates for this point. This is what you are expecting the spot rate will be, and this is the forward rate at present available in the market. What are you going to do if you can buy the dollar in the forward or sell the buy the pound and sell the pound in forward market at 1.30 when you know that it is going to be 1.32 in the spot market? Will you take a buy position in the pound or forward today or sell position? It's very simple, sir. Theoretical forward rate is this for you because that is what you are expecting. And this is the actual forward rate available in the market. And you can clearly see that actual forward rate is less. Okay. Actual forward rate is lesser than theoretical forward rate. Right. That means forward is undervalued. Means things are available at a cheaper price. So what are you going to do? Buy forward today. Buy forward means promise to buy the asset, which is GBP, pound in this case, after 3 months at 1.30. Obviously, it makes sense that since this is the lower rate for pound, we would want to buy it and sell it at this price. We would want to buy it at 1.30 and sell it at 1.32. So, the position that we are going to take, buy forward today, and we will close it by selling it. So, how much profit we are going to make? The difference between these two. $0.02 on every pound. Now let's have a look. $0.02 on every pound, that is 20,000. See, you should buy $1 million pound forward and sell it at this spot rate. Simple. But what would be your profit or loss in dollar terms on the position taken as per your speculation if the spot exchange rate turns out to be 1.26? See, on the basis of your estimation that it is going to go at 1.32, you took the forward rate. You bought the forward contract. You have taken a buy position in the forward contract, and after reaching to the end of the 3 months, you saw that the rates are $1.26 per pound. Is it 26? Yeah. You will be at a loss because your buying rate was 1.30. Your selling rate will be 1.26. You will lose $4.04 on every pound. That's a loss of $40,000. See, $40,000 loss you will lose. after taking a buy position, if the rates are going down, you are going to lose. If the rates are going up, you are going to make a profit. So this was the easiest question. This question was asked in RTP November 20 and RTP November 20 new and old syllabus. Okay. Question number 7 now. Following are the details of cash inflows and outflows in foreign currency denomination of this company, which is an export firm, which have no foreign subsidiaries. So this is an Indian company which might have exported some goods and might have imported some other goods also. So currency in terms of dollar, we have this much of the inflow, 4 crore dollar we are going to receive and 2 crore dollar we are going to pay. Today's rate for both is this, forward rate for both is this. French franc, UK pound and Japanese yen. Okay. Determine the net exposure of each currency in terms of rupee. How do you calculate that? It's very simple, sir. Suppose you have to make the, you will be receiving this and you will be making the payment on the same day. So receipt and outflow. So can I say that the net exposure in this case is 4 minus 2, that is 2 crore rupees. 2 crore dollar. I'm sorry. And in this case, it is 1 crore 60 lakhs of French franc. In this case, it is minus, it is 1 crore, and in this case, it is minus 1 crore. Since the payments are higher in this case. So the positive figures explains the receipt and the negative figure explains the payment, net, in net. Okay. So this is the receipt. If receipt will be sold in the market to get converted into rupees, the foreign currencies, and this will be purchased by us so that we can make the payments. Net amount is the extra payment. Okay. So if we sell those foreign currency today, the rate is 48.01. But if we sell it in the forward market, we are at a better situation because we are getting a better rate in the forward market for the receipt. The rate is higher. That means the inflow will also be higher. Understand? Net is inflow and outflow. Since there is an inflow in the first 3 cases, after deducting outflow from inflow, the net amount is inflow. You would want the forward rate to be higher than the spot rate so that you can get more money when you convert that in the under forward. So 48 if you will compare the spot and forward for the first currency, that is dollar, forward rate is giving you a better position. In this case also forward is higher, and in this case also forward is higher. So this is a win-win situation to you. The first win situation is when you have a net exposure in terms of receipt, and the second win situation is when you are getting a better forward rate. So both the things are positive for you. But in the last part, understand, you have a net outflow. That's not a win situation. That's an opposite situation. Nobody wants to pay money, right? So net amount is outflow. But that net amount or that bad news of paying ultimately is getting compensated with a better forward rate again. In terms of outflow, you would want the forward rate to be as low as possible so that the outflow will be lesser. So you can clearly see that this is again a better situation. When the spot rates are going down, it is going down in the forward market. So this is helping you to make less amount of outflow. If you make the outflow of 1 crore yen at this rate, it will cost you 3 crore 20 lakh rupees. I think it's yen. Yeah. But under forward, it will cost you only 2 crore 40 lakh rupees. So you can clearly see that the bad news is getting compensated with a good news in the forward rate. Bad news in the net exposure is getting compensated with a good news in the forward rate. But in all the other cases, all the news like exposure was also an inflow, that's a good news, and the forward rates were also better, that's again a good news. So good news. But in the last case, bad news is getting compensated with a good news. You can consider it this way. So Now come to this point. You can see that they have taken all the figures. Instead of crores, it is in millions. So 10 will be added to all the figures. And see, first they have deducted the outflow from the inflow. And you can see this is the net inflow. Net inflow in negative means outflow. And then this is the spread, which is the difference between spot and forward. This is not the spread that we have learned. The spread that we have learned is the difference between bid and ask, but there is no bid and ask in this question. The spread here is the exposed value for every foreign currency. The difference between spot and forward is the possible loss or profit to you. Possible loss or profit to you depending upon what is the net inflow or outflow. If it is inflow and the rates are better, that's a profit to you. And if the rates are not better, that will be a loss to you. So that's the spread, and you can see all the spreads are positive. Positive spreads means you are getting a better forward rate in this case, better forward rate. And here they are saying that it's negative, but it's not a proper way of explaining. Since they have written it as net inflow, that's why they had to write the 10 as net inflow in terms of negative. That means outflow, and that's why to negate the effect of negative sign, they had to write 0.80 also as negative, but it's a good sign. 0.80, you are getting lesser forward rate, so that's actually a good sign. 0.80. So what is happening, I will tell you. 20 million of dollar and 0.81 rupees. Understand? 20 million, yeah, 20 million of the dollar you are going to receive, and the risk on that is the difference between the two exchange rate, which is 0.81 rupees per dollar. So the total risk is 16.20 crore million rupees. This is in rupees when you multiply it with the factor. This could have been the loss if this amount would have been outflow. If this amount would have been outflow, because forward rate is higher. If the forward rate is higher and the amount is outflow, the 16.20 would have been loss. But since the forward rate is higher and this amount is inflow, this is becoming our profit in all the three cases. And when it comes to this outflow, okay, if the forward rate would have been higher now, let's say we are removing the negative sign out of 0.80, that means the forward rates are higher, because it was the same meaning carrying in the first three part. And at that time, outflow with a higher forward rate will give you a loss. And that's why they had to put minus sign here, so that they can explain that 8 is also a profit, sir. So this outflow is being compensated with a better forward rate, and ultimately resulting into 8 million rupees of the profit itself. So all the figures in the last column are resulting into profit. Receipt with a higher forward rate, outflow with a lower forward rate are going to give you profit only. See, receipt with a higher forward rate and outflow with a lower forward rate, both will give you profit. Receipt with a lower forward rate and outflow with a higher forward rate, both will give you losses. The question last part is asking, are any of the exposure position offsetting to some extent? Yes, sir. The Japanese yen position is being offset by a better forward rate, because in the Japanese yen the net amount was outflow, and that outflow, that bad news, was compensated with a good news of better forward rate. In the first three parts, both of the factors like inflow and outflow and forward rates, both were on the good side. So we cannot say that they are being offset. They are not being offset. Both of them are already on the good side. Bad news when offset by the good news is called as it is offset. Okay, let's come to the question number 8 now. Interesting question. This is based on the returns we are going to calculate. So small knowledge of the portfolio management is required here. With relaxation of norms in India for investment in international market up to 2.5 lakhs dollar. So India has relaxed the condition that was there earlier, that you can invest only up to $250,000 in the foreign market. Okay. that norm has been relaxed. Mr. X, to hedge himself against the risk of declining Indian economy and weakening of Indian rupee. When do you think the Indian rupee will weaken? See, if the rate today is 50 rupees per dollar and if it is going 52, and if the rate is today is 50 and if it is going 48, in which case do you think the rupee will weaken? In this case, the rupee will weaken because you have to pay more of the rupees to buy the same asset. In this case, you have to pay lesser amount of rupees as compared to the previous one. So in this case, the rupee value has strengthened. Okay, so weakening of the Indian rupee during the last few years, he decided to diversify in the international market. All in all, he wants to say that he will be investing directly in the dollar in the international market. And since the relaxation has been given by the Indian government also for investing the foreign currency, it is possible. Accordingly, now the real question starts from here. Mr. X invested a sum of rupees 1.58 crore on 1st of January in Standard and Poor Index. See, in India it is like Nifty. In India it is like Sensex. In the same way it is S&P index in America. On 1st of January 2002, this was 2000 whatever 11 or 1 and this is 2012 you can consider, Mr. X sold his investment. Just after 1 year, he sold his entire investment of 1.58 crore. The other relevant data is as follows. Index of the stock market in India was 7395 when he invested. S&P was 2028 when he invested. And the exchange rate was this much. If you have to see, in this case, this is the first question where you have to pick the rate from bid and ask. And I told you some clear points that you need to remember while picking up the rate. First of all, the base currency is dollar in this question. And bank will buy at 62. Buy what? Buy dollar. And bank will sell dollar. Both of these are going to be done by bank, not us. So write it like this. Okay. So if you want to buy dollars, bank will sell dollar and the rate will be this. Okay. The other relevant data is as follows. Okay, great. Now, you are required to calculate the return for US investor. US investor means what is the investment in US dollars and what is the proceeds when he sold his investment in US dollar, and the difference between two will be the investment return. See, it's not that difficult, man. See, first of all, you invested rupees, like you invested in dollars, right, on this date. So we will have to take some figures here. We had around how much rupees? I will just show you. 1 crore 58 lakhs. Let me just write it. Okay. What we would have done on that date, we didn't invest in India. We invested in America. And we need dollars for that. Right? So first of all, in India, we are going to buy the dollars. And if we want to buy the dollar today, at the time of investment, bank will sell the dollar. Bank will sell the dollar at this rate, which is 62.25. So the rate applicable here is 62.25. I told you, the calculations won't be that difficult, but taking a wrong rate here will make all your efforts zero. And you will get no marks for rest of the steps, even this single mistake at this point, if it goes wrong. Okay, so what will happen? You will receive dollar by selling rupees. 1 crore 58 lakh divided by 62.25, that's around 253,815.26. This much of the dollar was invested by you in S&P index. On that date, the S&P index was going at 2028. So S&P index was 2028 for 1, right? So this much of the dollar divided by S&P, both of them are in dollars, you will get the number of S&P index that you have purchased. that will be 125.1555. This much of the S&P index you have purchased on the same day. Okay, sir. Now what has happened? You have sold them on after just 1 year. Okay. So from this point we will be selling this much of the 125.1555 at what rate? The ongoing S&P index rate, which was 1919. You can see we have a loss in this case because we purchased at 2028 and we are selling it at 1919. And both of them are in dollars. 1919. You are going to multiply. Okay. And you will get around how much dollars? Obviously this is in dollar, right? So numbers multiplied by the dollar, you will get the dollars. 240173.32. Okay, sir. 125.1555 into 1919, that's 240173.40. So this much of the dollar was received by you, and you can clearly see there is a loss to you in terms of dollar investment. When you compare this investment with this, you can see we have a loss. Whatever it is, let's bring that amount to India and sell it in India. We want to sell dollar now. We want to sell dollar, that means bank will buy the dollars. What is the bank's buying rate for the dollars? This is the buying rate for dollar, 67.25, because we have purchased it at 1st January 2011 and we are selling it at 1st January 2000, let's say 21 and 22. So 67.25 will be the rate. This is the most important part, sir. Calculation is not that difficult. Picking the correct rate is the difficult part. After bringing dollars, you have to use all your imagination that what was your first step. You went with the rupees to the bank, purchased the dollar, went to the America, on the platform itself, and invested in the S&P index. You might have received some units out of that. You sold those units at this rate, right? You got some dollars in your hand or in your bank, and you are going to bring it back to India and sell the dollars to the bank. After that, you will, if you want to sell the dollars, bank will buy the dollars. What is the dollar buying rate? 67.25. So 67.25. And the net amount received by you is 1615161. So in this case, we can see we have a profit. So yes, sir, this can happen that there is a loss in case of dollar, but profit in case of rupees. The loss in dollar is being compensated by the change in this exchange rate. This exchange rate has changed to such a level that it had made us profit. So the entire profit is because of the change in the exchange rate, practically speaking, because otherwise it was a loss. So now if the question is asking you the profit or loss in terms of dollar, you can calculate the difference between these two. In terms of rupees, you can calculate the difference between these two. Okay, so let me just go through the question. The return for a US investor, this is in dollar. Holding period return for Mr. X, that means he is from India, so that is rupees. Let's first find out these two answers. So return for Mr. X, you can see 161,522.42. See, 1615, 1661, 2242. That might be because that's just around 600 rupees of the difference because of, I think, rounding off. That's some rounding of difference, because you can clearly see the calculations are correct. We'll see where we have gone wrong. 158 crore at 62.25, 253,815, right, at 2028, 125.16. So they have rounded off the index into 16 and we have made it to 1555. So this has made all the difference, and because of that you are getting lesser amount in the other case. And the same units you sold at 1919 and you got 241.82, so that's 241.73 in that case. And when you sold it at 67.25 you got 161.522.42. so the difference between these two will be your profit or loss. So in this case it is a profit, but if you compare it for the US investor, see, if for the US investor it's very simple, 1919, 2028 and 2028, because when you invested the rate was 2028 S&P index and when you sold it was 1919. So you don't have to calculate the number of units as well. In that case you can easily calculate it with this number itself, $5.37. Okay, whatever was the loss in S&P, that's the same loss to you in dollars. Okay, now the last part, the value of index of the stock market in India as on 1st January 2022, at which Mr. X would be indifferent between investment in Standard and Poor index and India's stock market. What does that mean? It means that what value, understand, what value of index in the stock market will give Mr. X the same return that he has earned by investing in Standard and Poor index. It's very simple, sir. He has earned around 2.23% by investing in the Standard and Poor index. Don't consider this investment. Question is clearly saying about Mr. X, not an US investor. So Mr. X has earned 2.23% return. If the stock market in India goes up by 2.23%, that will solve the purpose. That's the simplest of the part. You just have to increase the Indian stock market by the same percentage of the return of Mr. X. So if the Indian stock market goes up by 1.0223 to 7559.90, so practically it is 7560. So if it goes to this level, then investing in Standard and Poor for Mr. X will result into same return as investing in the Indian stock market. That's it. 7560. Let's just find out. See, initial investment purchase, you don't have to do this much of the things. You don't have to seriously do this much of the things. You should write one sentence. If we want to make it indifferent for investing, for Mr. X to invest in US market and Indian market, then Indian market should also give the same return as US market. And that's why after writing this sentence, what you can do is, it's very simple, sir. See, value of the stock market. Current value into 1.0223. That's it. 7560. That's it. Because you would have invested in the Indian stock market at this price, you would have sold it at this price, the result would have been 2.23%. That was the same return for you in the US market. It's as simple as it is. Don't make this blunder of making the calculation so long. Okay, sir. Coming over to question number 9, you are going to enjoy this a lot now.